It's all about the tech sector within the equity market.
We might be a little bit overbought here.
You have very strong sort of earnings fundamentals underpinning things.
Everyone is looking to make sure that this growth is still as strong as it has been.
The outlook still is optimistic.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, division grows. A divided Federal Reserve just about holding on to an easing bias as failure to find a diplomatic solution with Iran is keeping crude elevated. Performance of some of the world's biggest companies beginning to splinter. Meta slides, Alphabet climbs.
Let's just put this into perspective. $725 billion. That is how much the four hyperscalers that announced earnings after the bell, the three with Meta, announced after the earnings for this particular year for CapEx X. How much is this justified? And that's where the splintering comes into play. For Alphabet, they're crushing it in terms of the acceleration of their revenues. People say, great. For Meta, it's increasing because component costs are increasing. And what they're going to do with it, trust us, not exactly flying in markets right now.
Will this tech story keep this equity market supported with this developing in the commodity market? This from Axios this morning. And for once, the Axios story is not bullish. President Trump slated to receive a briefing on new plans for potential military action in Iran. Wartime highs on crude just off those levels this morning. Brent pulling back from 120. Brent this morning around 116.
So we really need to understand what options are going to be presented to the president and then what decision he makes. At the moment, what we've seen from this president is he's willing to keep the blockade, have this impasse, no need to escalate, no need to de-escalate. If leverage is what the Iranians hold in the Strait of Hormuz, potentially that is what the president could decide when it comes to an escalation. Maybe not striking targets in Iran, but maybe the Navy has to come through and start escorting tankers through, because can they live with these oil prices? Look at where gasoline is this morning in California, north of $6 a gallon.
Do we get some soothing words as we get closer to the opening bell? Maybe, but bear in mind this. April 17th. The president came out and said the Strait of Hormuz was reopening. Over the weekend, it didn't. Ever since, we have not had a down day for crude. Ever since then. This market has really snapped into show-me mode. The hopium no longer bites in quite the same way.
Exactly. Verbal intervention doesn't hold the same kind of punch. And right now, this is coming at a time where economies are not yet breaking. So you've got fiscal and corporate stimulus, if you will. At the same time, the oil prices are going higher. And suddenly, we're talking about a new kind of tightening of financial conditions, a 40% chance of a rate hike by next March by the Federal Reserve. All of this comes together with this real tension. How long can risk assets keep rallying?
Let's go through some of the levels we're at this morning in the bond market. Country to country, starting with the US. Near the highs of the year on a 10-year yield. In Germany, back to the 2011 highs. In the UK, numbers we haven't seen since around 2008. Over in Japan, the 1990s. We're back to March again. We're hitting those kind of levels once more.
We're above 2.5% in Japan. Just a couple of years ago, we were at zero. The idea of 2.5% in Japan is like getting 10% in a lot of other places, considering that they own the bond market, and this has not been a market for a very long time. Does this reset expectations? And again, I go back to what is the exit strategy? If we have higher oil prices, but we don't have an economy that is torpedoing, and if anything, governments are saying, we'll support you, consumer, because politically it is going to be disastrous for us not to do this. That is why you're getting a real hesitance from buyers of the long end, exactly what levels they're going to accept.
And now Japan's finance ministry threatening to intervene in the FX market because of the moves we've seen in the Japanese yen. Later this morning, programme note for you, 9:30 Eastern Time. We'll extend the programme. We'll bring you the news conference with Christine Lagarde over at the ECB. After that, we'll catch up with this guy right here, the NEC Director, Kevin Hassett, following quite the announcement from the Chairman of the Federal Reserve just yesterday in the news conference. He's stepping aside for Kevin Warsh, but, and it's a big but, he's sticking around. He's staying on the board.
He wants to see the process concluded with full transparency, the process of legal challenges. And he said that that has been an attack on the institution of the Federal Reserve. I'm sure there'll be some harsh words. We heard from Treasury Secretary Scott Bessent yesterday talking about how this was an insult with respect to his staying on. A real question about what the administration's response is going to be.
Well, Jay Powell yesterday, and great job, guys. I watched the whole Fed programming. He said he's going to keep a low profile, but at the same time, he had this stature of Fed chair. So how do you keep a low profile? We didn't just hear from the Treasury Secretary. We also heard from the President of the United States, a brief truth for the president, but he said he wants to stay at the Fed because he can't get a job anywhere else.
I thought that was a lightweight truth. a lightweight social media post.
I also
was
think it's
nothing
false.
compared to what I was expecting to see from the president after that announcement yesterday. I didn't think that was much at all.
To me, that was almost an endorsement of his staying on. I mean, not you're fired. This is war. We're going to, we're going to go to the straight and hash this out. I mean, truly, that's the kind of stuff I was expecting.
That was pretty tame stuff. Yield to lower this morning by 3 basis points. 10's around 4.40. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore, with markets whipsawed by earnings. Victoria Coates of the Heritage Foundation as the US-Iran standoff sends crude surging, and Dutta of Renmac, with Fed Chair Jay Powell passing the torch. Kinda. We begin this hour with stocks wavering after crude surged and mixed tech earnings are failing to spark a rally. Julian and Emanuel of Evercore writing, the base case remains the tech-led bull to 77.50. The independence of stocks and the economy from malign triple-digit crude will not be sustainable. Julian joins us now for more. Julian, good morning.
Good morning.
Good to see you, sir. Are we reaching a tipping point?
Well, what you just put up is kind of a contradictory statement. We think that the bull market is predicated on number one, earnings, which have been off the charts, absolutely off the charts. But you are at this point where the malign effects of oil will not be ignored if this goes on much longer.
Well, let's go with the last 24 hours. What do you believe is more consequential, the move in crude, the earnings we got, or what we heard and saw from the Federal Reserve?
Yes, all of them.
You can't pick one, all three.
Well, I would have to say that earnings. Look, again, and we've been very adamant about it. We've been adamant throughout the entirety of this 3.5-year bull market run, is that if you look at a multi-decade chart, earnings and stock prices have a very, very close correlation. And it is no surprise, if you think back 30 days ago, where we were in the depths, despair, but yet you're still in an environment where the market has ripped higher, as crude has ripped higher, as yields, as you pointed out, have ripped higher. Why? Because earnings are ripping higher.
This is the big question. Lisa talked about the bond market. Yields are back to where they were, and through those levels in some cases, at the end of March. Annmarie went for the reasons that we've got through crude back to wartime highs, at least briefly, in the last 24 hours. All of those stories have gone back to the end of March, with the exception of equities, which have had a move of 13% off the lows of March. Do you really believe that story is insulated because of earnings from what's happening elsewhere in other asset classes?
In the medium term, it cannot be. In the near term, it is, again, because going back to the call we made at the end of last month, is that the hedging that we had seen in the markets was unlike anything that we had seen over the last 30 plus years of doing this. And so almost by default, unless the world was ending in that moment, you were going to get the degree of rally which you got, which by a lot of measures was as strong as what started this generational bull market in August of 1982. But again, just going back to where the situation is, there's an optionality component here to, at some point, triple-digit oil is going to cause the economy to slow and is going to cause earnings to slow with it. We just, our work has said the 4-month window is really, really sort of the time looking at past spikes. Where that comes into play, we're getting close.
Except for tech. Because ultimately, that's what everyone's been saying, except for AI spending. And that would be the one thing that ultimately keeps going, because ultimately, as my son told me last night, AI beats humans, and we can all just rely on our chatbots more than we can our mothers.
You had a good evening.
I was fantastic. I'm really existential this morning. Please watch out. But I am curious about, from your perspective, at what point is this CapEx plan unsustainable if it's just to pay for higher and higher commodity costs that are the inputs to what they're trying to build?
Well, that is a challenge, disaggregating, and that's why, one of the companies that reported last night is softer, because you can't disaggregate, what is higher input costs and what is, organically higher CapEx intentions. And that is, an issue. But look, again, all of this is predicated on the fact that you can have a continuation of this build-out, provided two things. Number one, that conditions in the economy and the credit markets remain benign, which they clearly are, despite triple-digit oil right now. And this idea that there is an eventual payback window for the AI build-out. And again, the evidence is that there is adoption going on. The evidence is that it is driving revenues and it is saving costs. Is it as fast as the market would have expected it to be? No. But because the economy is as benign as it is away from oil, there is patience.
So I want to come up with another expression than boiling the frog, because Pete is coming after me. But I'm curious also about at what point you hit a tipping point in terms of you have CapEx that keeps increasing because it feels existential and independent. You have yields that are going up because people can keep spending, which allows inflation to keep going through the system. You have enough resilience to keep those yields high. At what point do the yields become the breaker to this entire cycle?
Well, and that's why this is a challenging environment, because as we've seen over the last several months, yields are moving higher in lockstep with the price of crude oil. And so that it really points to the fact that this is a time optionality to all of this. My answer to that would be is that, until the economy shows signs of cracking, this is sustainable, okay? There are no signs of cracking right now. Remember, a couple months ago, we had credit angst all swept aside. It was an issue that we know now has been contained. But essentially, what you're looking for is signs of stress, and there aren't any at the moment.
How many months can we live with triple-digit crude?
Our work has shown that sort of month 4 is where things get dicey. Again, it's also the amplitude. In our mind, if you break the prior March, the beginning of the cycle high, around 120 on WTI in a material way, that will accelerate the timeline. But otherwise, we're looking at sort of Independence Day, July 4th, as kind of a line in the sand.
It's $99 in the futures curve for July. That's triple digits, basically.
It is. You are essentially at that, which is why it's incumbent for the prices to find a way, whatever that way is, to moderate between now and then.
Julian, it's good to see you. You're going to stick with us, I'm pleased to say, to break down some of these tech earnings just a little bit more. Julian Emanuel there of Evercore. For your equity market this morning, and good morning to you, just about positive by 0.2% on the S&P. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. President Trump defending the U.S. blockade of Iranian ports, saying it's more effective than bombing the country. Trump rejecting the latest Iranian proposal to open the Strait of Hormuz and lift the blockade until concerns about its nuclear program are addressed. Axios reporting the president will receive a new briefing on the situation today. Mag 7 earnings in full swing. Shares of Alphabet are rising after the tech giant reported solid growth at its cloud computing unit. Amazon also beating on key metrics. Meta, though, falling after issuing a CapEx forecast that was higher than investors expected. The Federal Reserve holding rates steady in Jay Powell's final rate decision as chair. 4 policymakers dissenting against the decision, with 3 opposing in particular, the language suggesting the Fed will eventually resume rate cuts. One, Governor Stephen Miron, preferring a quarter-point rate cut this time. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Good to have you. More Vonnie Quinn a little bit later this hour. Up next on the programme, wrapping up a monster day of tech earnings.
The 3 critical data center businesses, the hyperscaler businesses, exceeded expectations. They're all still accelerating. Meta's not even in the top 10, I would say, in terms of its frontier model.
We'll talk more about Meta in just a moment. Stefan Slowinski of BNP Paribas joins us next, live from New York City this morning. Good morning. Coming up a little bit later, 2 central bank decisions, 7 a.m. Eastern time. We'll hear from the Bank of England. Later at 8:15, we'll hear from the ECB. Then we've got economic data at 8:30 Eastern time. Jobless claims and a whole lot more. Then after the close, the other big tech titan, Apple reporting after the close a little bit later.
Does it matter? I guess this is a real question. How much does the backward-looking data for Apple matter, and how much is it going to be the show of who's taking over and what they're planning to do? Is there going to be some sort of CapEx plan that's going to be announced to talk about exactly how they're going to bring AI into the iPhone?
You brought up the really important question for Meta. Meta's increased CapEx. Are they doing that because there's more things to buy? Or the things to buy just got more expensive?
We don't know. And ultimately, we heard this tone also from Microsoft. Others also increased their CapEx plan, partly because the cost is just going up, and we've heard this from everyone. So at what point are they actually getting more for their increased costs, or are they just simply having to pay more? And is that something that's digestible for people? AI at what cost?
Nasdaq futures this morning positive by 0.2% on the S&P 500, up a little more than 1/10%. Under surveillance this morning, wrapping up a monster day of tech earnings.
The three critical data center businesses, the hyperscaler businesses, exceeded expectations. They're all still accelerating. That's a very good sign in terms of the progress of AI. Meta's not even in the top 10, I would say, in terms of its frontier model. Investors are going to expect them to either calm down on the CapEx or reduce enough OpEx to allow margins not to be degraded.
So here's the latest this morning. Big tech earnings kicking off with Alphabet surging on high demand for its cloud and AI platforms, while Meta's CapEx forecast is fueling investor doubts. Joining us now to discuss is Stefan Slowinski of BNP Paribas Exane. Stefan, welcome to the program. I want to talk about Meta exclusively. Just first off, they've raised their CapEx. Lisa and I were just talking about it. Are they doing that because there's more things to buy, or the things they wanted to buy just got more expensive?
Yeah, good morning. I think it's mostly inflation. So you see Meta raising CapEx by $10 billion and talking about the component price inflation. Microsoft talking about close to $200 billion of CapEx this calendar year. And they're highlighting that $25 billion of that is just coming from that component price inflation. So I think that is one of the flies in the ointment today. Those were four great set of numbers yesterday, especially on the top line, but also margins expanding for all four by 125 basis points on average. But CapEx keeps going up, and increasingly that's being driven by inflation.
And some companies are being punished for it, others aren't. Meta's being punished for it. It's down by 8% in the pre-market. Do you think, Stefan, that's something they just continue to stomach?
I think when you look at the reactions today, what you're seeing from Google and Amazon is they're chip companies now. And so one of the big trades of the past year and the past 3 years has really been hardware over software. And so when you look at Amazon, when you look at Google and their proprietary semiconductors, Inferentia and Trainium, they're going to be increasingly selling those to enterprises and to third parties. So they're in a way a beneficiary of that. Microsoft and Meta are behind on their proprietary silicon, and so they have to stomach those costs a bit more than the other two.
How much, Stefan, do we see the market starting to say we're going to go with the promises of Amazon and Alphabet, because they do go beyond just the chip production, obviously, and they're direct competitors with Microsoft in particular. Is Microsoft truly falling behind?
I think when you look at the results last night for Microsoft, Amazon, Google, the big hyperscalers, they did all see growth accelerate in the quarter. Interestingly, when you look at the quarter, Google added the most incremental revenue, even more than Amazon and Microsoft. So they're officially kind of neck and neck now with the big two. But what I think you're also seeing is not only are all three of them benefiting from enterprise cloud demand, but their core businesses are benefiting as well. So Google search going from 17 to 19% growth. It was 10% just a year ago. Microsoft, the big concern was Microsoft 365 commercial cloud, the kind of office business that would be disrupted by Anthropic, but growth actually accelerated to 15%, and we're seeing Copilot demand finally boom. And even Amazon's core business is still doing low double-digit growth. So that's reassuring for all of them that they're monetizing AI, not just in enterprise cloud demand, but in their core businesses. And finally, I think the other thing that's really positive is it's not just renting out GPU infrastructure to model companies. We're starting to see that cloud monetization broaden out to other products, especially software products, databases, data platforms. And that's important because those are higher margin businesses. That's what drove high margins in Cloud 1.0. And the companies are increasingly saying they're seeing signs that that will help drive returns in Cloud 2.0 in this GPU cloud build out.
Stefan, how long before CapEx becomes a nice to have versus a need to have?
Well, right now it's still a need to have. As you pointed out, we were at probably $725 billion now between the big four and CapEx this year. Last night, Google said next year, 27 will be up significantly or meaningfully. So we're going to blow through $1 trillion probably next year. Thankfully, we are seeing the uses increase. Thankfully, we are seeing the monetization. But as we're seeing in Microsoft a bit today, and certainly Meta, if you don't have a clear path to monetizing that CapEx via multiple routes, via new AI businesses, via your core business, maybe via hardware and other capabilities, the market's going to increasingly scrutinize that CapEx spend, even if your core business is doing very well, as it is in Meta's case, growing 33%.
Stefan, it's good to see you. Thank you, sir. Meta down by close to 9%. The story of Alphabet, the turnaround there in the last 12 months, absolutely phenomenal. Meaningful acceleration of growth, crushing guesstimates. CapEx, $185 billion for this year. That's double last year. The turnaround here. Imagine me saying to you last year when people thought they were in some kind of existential moment, they'd come out with numbers like this 12 months later.
Yeah, and they're winning on search. They're beating, actually, ChatGPT. They're beating the OpenAI product in a material way and saying not only does it not replace search, it enhances it and brings more viewers in. Their earnings per share was $5.11 versus the estimate of $2.62. That gives you a sense of the scope of this beat.
Julian, still with us. Julian, let's go through some of these numbers, these results. Things can move really quickly in this sector. The last year's demonstrated that. But are we beginning to expose the winners and the losers of this sector?
I think there's two lessons here. Number one, we have to adjust our thinking. It used to be that billions impressed us. Now it's trillions, okay? Because cumulatively, and our semis analyst expects the CapEx number to be 1.1 trillion in 2027. And the other thing is that the laws of size are just so evident. Because if you heard your last guess, basically the spoils are accruing to the companies that now do other things well away from their original mandates, so that they are total enclosed ecosystems of AI. And you only do that with size that is evocative of the concept of trillions.
Are any of these going to become the next AOL? I mean, are any of them going to become rendered obsolete on some capacity as the world moves on and some of the behemoths win share?
It will happen at some point, but frankly, I'd prefer that doesn't happen. As a very young trader, I was sitting in the proprietary trading room when the AOL-Time Warner merger was announced in the beginning of 2000, and all the gray-haired vets looked at each other and said, uh-oh, I think this is over now. And, of course, that was the top of the Y2K bubble. So let's hope it doesn't happen in AOL style.
You gave the sense that this feels a little bit like 1999. Are we in February? Are we in December? Are we December 31st? I mean, kind of where are we in 1999?
So the swing factor...
Pick a day, Julian. Be precise.
My son say I would. No,
well, I will tell you, I had a number of clients last night email me asking me to pick a day. It goes back to the economy's strength, which is inextricably linked to the amount of stress that's going to be caused by the elevated oil price. You remember, 1999, the Fed hiked 175 basis points to stop the bubble, which they did ultimately in Y2K. The question is oil going to have the same influence? The Fed, I don't care what the implied probabilities are, the Fed is not hiking this year, okay? That's, again, we said that a number of weeks ago. We'll say that now. They may not cut. And frankly, at this point, you'd rather not see them cut, because if you're going to get a cut right now, it's because the economy is weakening. But the point here is that we are in a time where if oil is the handicapping feature, you could have a sudden rollover. But again, we're not there.
Julian, it's good to see you. Thanks for joining us this morning. What are 24 hours in financial markets? Julian Emanuel there of Evercore. The latest out of Iran, according to state TV. We're waiting for a statement from the supreme leader, someone we've not seen or heard much from over the past 2 months. That from state TV just moments ago. When we get that statement, those headlines, we'll bring it to you. Up next, Victoria Coates of the Heritage Foundation as President Trump reportedly weighs new options in Iran. Q1 felt like a lifetime. April, blink and you missed it. Final trading day of April, up on the month on the S&P 500, higher by more than 9%, potentially on the S&P. The biggest monthly gain going back to November 2020, and we saw some big monthly gains back in that year. Equity futures this morning up by 0.2 on the S&P 500, on the Nasdaq up by 0.3. The S&P totally unchanged just yesterday in the face of these moves in the commodity market, which is crazy. 8 days of gains for Brent into today. We'll see if we make it day 9. We're pulling back this morning to 116.50. Over those 8 days, higher by 30% over that period.
And you have seen it bite in certain areas. At the same time, the technology trade has just overwhelmed some of the oil concerns. Semis with the best month, as you were mentioning, since 2000. Going forward, though, I think that what Julian and Emanuel was just talking about is the key point. We're going to hit a breaking point. Stuart Kaiser was talking about this as well. And when you start seeing prices stay at these levels for even just a couple of more weeks, we might hit that point.
Getting closer. We're not there yet. We're pulling back on crude just for now. Let's turn to the bond market. There we've seen some pretty interesting moves. On 10s and 30s, the highest close of the year so far in yesterday's session, pulling back from those levels. 497 on 30s after having a little look at 5%. The 10-year was through 440, now back down to 439.47.
We hit 5% on the 30-year, and this came as global bond yields crept higher in the face of the oil price shock and potentially central banks led by the Federal Reserve that are not thinking of rate cuts anymore and, frankly, seeing actually a chance potentially of a rate hike, even though Julian and Emanuel just said there's no chance in hell. And we also are getting that sense that they're not even willing to move to a neutral position. Nonetheless, this clearly is a quagmire for the central banks, and clearly it's being reflected among the bond traders.
And these are obvious headwinds for markets, but the earnings story has been so powerful in certain parts of the stock market in America. Take this one, just dropped. Caterpillar, first quarter adjusted EPS, 554, the estimate 463.
This is the industrial renaissance. You need this equipment in order to build stuff. And guess what? Everyone's building stuff. You also saw Ford beat expectations yesterday. People are buying cars. Every cylinder of the economy was set to actually outperform. And so suddenly you're seeing these earnings come through in a bold way. You're talking about how the earnings came in better than expected. Machinery, power, and energy revenue came in at $16.5 billion. That is more than $1 billion more than expected, to give you a sense of where some of these gains are coming from.
A few headlines I want to work through here, just away from Caterpillar and the earnings story. I mentioned we were waiting for a statement from the supreme leader in Iran. Those headlines just slowly crossing the Bloomberg terminal. AMH, what do you see?
So he's saying that there's a new chapter taking shape in the Gulf when it comes to the Strait of Hormuz. And that new chapter, obviously, is that the Iranians have full control over it. They're charging tolls and they're going after Western vessels. Still waiting to hear from him more. He says he's giving this statement on Persian Gulf Day, which they do every year. But Persian Gulf Day is to commemorate the Iranians pushing out the Portuguese in the 1600s from the Strait of Hormuz.
We'll come back to that story in just a moment when we have more. As we count you down to the opening bell, we're about 3 hours away. Lots of single names, some morning movers for you. Yahara has more. Hey, Yahara.
Hi, John. We start with big tech, of course, and it all came down to who's seeing the payoff from AI. Alphabet clearly is. Shares are up 6.7% after a clear beat due to cloud growth accelerating, and Amazon shares also up after AWS posted its fastest growth in years, helping investors look past heavier spending. Now we get to the laggards. Microsoft down 1.5% after Azure just failed to impress investors, especially stacked up against Google and AWS. And at Meta, you're seeing a revolt from investors due to higher spending. So those shares down 8.7%. Turning to Qualcomm, those shares soaring 12% in the pre-market after CEO Cristiano Amon teased that they will be shipping custom AI chips to an undisclosed hyperscaler later this year, a sign they're getting into the red-hot AI data center market, that helping investors look past a softer outlook due to higher memory costs. And turning to another chip maker, Intel, those shares are up 3% in the pre-market after a 12% surge yesterday that brought the stock to a record high and seemingly inspired President Trump to tout the government stake in that company, posting on Truth Truth Social that he's very proud for making that investment and making the U.S. over $30 billion in the last 90 days because of this rally. John?
Yahara, thank you. Thank you very much. On our radar this morning, crude hovering near wartime highs on fears the U.S. is considering new military options in Iran. Axios reporting this morning that the president will receive a briefing from the CENTCOM commander after rejecting Tehran's latest deal. Elsewhere, the White House opposing a plan by Anthropic to expand access to its Mythos AI model. Sources telling us here at Bloomberg that U.S. officials are concerned the company lacks the computing power to guarantee security. And finally, the Trump administration blasting Jay Powell's decision to stay on at the Fed after his term as chair is complete.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh, Mickey Bowman, and Chris Waller to think that these other Republican nominees do not care about the institution of the Fed.
The president writing on Truth Social, quote, Powell wants to stay at the Fed because he can't get a job anywhere else.
I love that he mentions the Republican nominees. Guess who else is a Republican nominee? Jay Powell, who actually was nominated by President Trump. So, I mean, in fairness, okay. On the other hand, the fact that President Trump didn't come out more severely against Jay Powell was interesting. I was expecting lawsuits. I was expecting a standoff. I was expecting potentially something further. Maybe people are saying this is going to give Kevin Warsh a bit of a reprieve, actually, in terms of his next steps.
We're going to spend some more time on this. We've got the whole morning to go through this. I think we've all got thoughts on what took place in the last 24 hours. Stay tuned for that. We'll also catch up with Neil Dutta a little bit later as well, I believe. Let's get to crude, hovering near 4-year highs with President Trump reportedly gearing up for a military briefing on Iran that could open the door for fresh escalations. Jonathan Tamari of Bloomberg Government joins us from Washington for more. Jonathan, welcome to the programme. What do we know so far this morning?
So far, as we know, the president is supposed to receive a briefing today from CENTCOM commanders. Joint Chiefs of Staff Chairman General Dan Kane is also supposed to be there. He's going to get a range of options, according to Axios, from bombing, from more direct action to try to take control of the Strait of Hormuz, to potentially sending in special forces to grab the enriched uranium that Iran has. All at the same time, the president yesterday also told Axios that he saw the blockade as somewhat more effective than the military action that he's taken. So he's laying out a range of options, and you never know with the president what he's willing to actually do and what he's doing to build leverage in potential negotiations.
I'm not sure these headlines just crossing will help the diplomatic effort. Jonathan, thank you. We appreciate it. I just want to read some of the headlines coming from Iran's supreme leader. This statement brought to us by Iranian state TV that Iran will dismantle U.S. exploitation of Hormuz, that new management of Hormuz will benefit the region. I'm not sure if Gulf partners in the region right now would see it the same way.
Absolutely not. This is not acceptable to the UAE or Saudi Arabia or any of the Gulf partners that use the Strait of Hormuz. And also, some of them are also right there as well, like Oman, in that body of water. But of course, this is Iran's one piece of leverage. So what Jonathan is talking about in that Axios report, if the president wants to potentially use military assets, it might be just at the Strait of Hormuz. Maybe that means naval escorts like we saw in the 1980s. Unclear, but this is the piece of leverage that's starting to really hit the oil market.
Here's the take from Victoria Coates of the Heritage Foundation writing the following. We're going to have a tipping point in the coming weeks where Iran just can't sustain itself anymore. That's when the president will have the most leverage. Victoria joins us now for more. Victoria, welcome to the programme. This is a high-stakes blinking contest. With that, there is no doubt. Which side do you think is better positioned to wait it out?
Well, Jonathan, good to be with you. I think that for all the reasons you've been discussing this morning, the United States is best positioned to wait this out, if you will. And we have to look at what's actually happening to the Iranian economy. We had some really important reporting yesterday on the first metrics we've gotten out. And bear in mind, I mean, they haven't had a stock market for more than 2 months. It's been shut down. Nobody knows what their equities are worth, if anything. Their currency is down. If you look at it over the last 10 years, it's down 98%. And so you just have a lack of value in that country that is catastrophic. And Secretary Bessent was talking about this yesterday as well. The economic fury, the economic front of this war is what is sort of causing the devastating consequences to Iran. They can't go on that much longer. We're not happy about our oil prices. I think Julian was absolutely correct. This is putting a lot of pressure on what should be a very successful time for the economy. But at the same time, it's apples and oranges what's happening in the United States and Iran, and they're going to have to blink.
Victoria, no doubt that the Iranian economy is in dire straits right now. But how long can this administration deal with $107 and going north when it comes to WTI?
No, I mean, this obviously is something they're going to have to bring down. And I think that's why the president's getting that briefing today. And there are a range of options on the table. There always are. General Kane, the chairman of the Joint Chiefs, is someone in whom the president has enormous confidence. He's performed extraordinarily well over the course of really the last year and months, but very much over the course of the last 2 months. So they can look at the kind of military action that would force an opening of the strait. I might favor that personally. I'd want to see the details. We do have options in terms of our special operators who are specially trained to deal with nuclear material. So you're getting a person who's both a special operator and a nuclear scientist. That's quite a combination. I think we're the only ones who have that. They could go in and go after the highly enriched uranium. And you also have the infrastructure targets that the president's been talking about for the last week or so that would have that kind of final crippling effect on the Iranian economy.
Well, when it comes to opening up the Strait of Hormuz, in this Axios report, it says that such an operation could include ground forces. One source said, what would that look like?
Well, I mean, that you would have to see how, as I said, I want to see the options here. And there are a lot of reasons we shouldn't be seeing them. But at the same time, I mean, you can put people on the Iranian side of the strait to prevent them from using ships and missiles against any maritime traffic coming through the strait. You could put in some demining efforts to get rid of the some dozen mines they've theoretically put in there. So, and then you could have the naval escorts that you were talking about. So you can use our Navy assets to escort the ships through and prevent the Iranians from attacking them.
Yesterday, Victoria, we got signs that the U.S. Central Command has prepared a plan for a, quote, short and powerful wave of strikes on Iran. Do you have any sense of what this would be focused on?
I think in that case, Stephanie, we're looking at the infrastructure targets that the president was talking about, bridges, power plants, that kind of facilities. And this is going to be what would really shut Iran down, prevent people from moving around. We're already seeing these reports of their big industries starting to close. They've lost as many as 1 million jobs. And that what that would be crushing about this is there may be 10 to 12 million more jobs that would be at risk if the president took this kind of action. That's 50% of their workforce. So essentially 50% unemployment happens overnight to Iran. And you just wonder how the country can continue functioning after that.
Victoria, always good to hear from you. Thank you for the update. Victoria Coates there of the Heritage Foundation on who has the leverage and what the next steps might be.
Yeah, difficult to know when Iran is talking about new management. I'm wondering if they're going to put up a new sign, new management, under new management, come through the Strait of Hormuz today.
On the strait.
Exactly. Please come through.
I'm not sure that would encourage people to go through.
I don't think that people would welcome that new management.
The Treasury Department just put out an advisory this week, not just to Americans, but really more importantly to foreign buyers about if you pay that toll, you will have the consequences of U.S. sanctions.
Let's give an update on stories worldwide this morning. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. Shares of Qualcomm higher in pre-market trading. The chipmaker reporting growth in the data center market and predicting that the China phone industry would bounce back. Qualcomm also sharing a top hyperscaler is on track to start using its components later this year. Anthropic is weighing a fresh funding round that would value the company at more than $900 billion. Sources telling us here at Bloomberg, if successful, the AI developer could surpass longtime rival OpenAI as the world's most valuable AI startup. Saudi Arabia's public investment fund is ending its financial support for Live Golf after this season. Sources telling us here at Bloomberg, the league has already been engaging with investment banks to secure new long-term financial partners. The Upstart Golf League has an announcement scheduled to detail next steps. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Quite an update for the golfing world, that's for sure. Up next on the programme, Powell's Stick It Around.
After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor.
You know that meme from Wolf of Research? Wolf of Wall Street.
Exactly what I thought.
Right. Wolf of Wall Street.
Yeah.
Get my words out.
Leonardo
Post-Fed, never
DiCaprio
good.
comes out.
Yes, I'm not
not
leaving.
going.
Yes.
Yeah. Then everyone cheers.
I think there's a new meme.
But there was no cheering.
I thought it was pretty cool too, right?
Get up. You're not keeping a low profile.
Ramo had a late night.
Well, we both had a late night. I mean, this
Did
is
they
what
mix
it is.
up the drinks at the table yesterday with TK?
Maybe. That would be fun.
Neil Dutta of Renmac joins us next. Live from New York, you're watching Bloomberg TV. Equity futures picking up here, higher by 0.2% on the S&P. Similar move on the Nasdaq 100. Under surveillance this morning, he's not leaving.
After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have, I think, left me no choice but to stay until I see them through at least that long.
Here's the latest this morning. The president blasting Jay Powell's decision to remain at the Fed after his term as chair ends, claiming he only wants to stay, quote, because he can't get a job anywhere else. Neil Dutta of Renmac writing the bar to raising rates this year has just come down. For Warsh, it might be a waiting game. Neil joins us now for more. Neil, welcome to the programme. I think we want your initial reaction to the chairman staying on as a governor on the board of governors. How consequential do you think that decision might turn out to be?
Well, I think it's consequential. Obviously, it's not something that happens often. It hasn't happened in our lifetime. So you have to go back a long way. But look, I mean, nothing about this process since it started, when we had Fed Chair Celebrity Apprentice Edition, has been normal. So why should Powell abide by norms when, 1600 Pennsylvania Avenue isn't?
Neil, do you think it undermines, in the words of the Treasury Secretary Scott Bessent, undermines the other Republican nominees on the board?
No, they're all big boys and girls. They can fend for themselves, and they've done that. They've all shown themselves to be, independent and changing their views in the face of economic data.
Do you get the sense that President Trump is almost conciliatory in his lack of saying that he was going to fire him or anything that we were all expecting, and that moving forward, this can be sort of a footnote and not necessarily center stage in policymaking?
Yeah, I mean, I think the best way for the president to get what he wants is to not comment on the personnel within the Fed. I think right now, we'll see what happens with the Lisa Cook investigation. I mean, my sense is that Powell's probably waiting for some clarity around that before he makes his next move. And I think my advice to President Trump would be, don't take the bait. Don't take the bait. I mean, if you try to Lisa Cook Jerome Powell, I don't think it would go well for the administration, but more importantly for the financial markets.
The other aspect of this press conference was the fact that there were 8 people who voted to keep the rhetoric the same. There were 3 people who voted to move to a more balanced, more symmetrical risk. And there was 1 person, Stephen Myron, who voted to cut rates by 0.25%. Do you think that it's a mistake to move to more symmetric language where the next move could be a hike or a cut?
I think it would be a mistake. I think it would be a relatively small mistake in the face of the data that we've seen. I mean, at the end of the day, as Powell mentioned, I mean, it's hard to argue against the idea of lowering the bar to hikes, which is, I think, what happened yesterday. Inflation has been strengthening. There's reasons to expect additional pass-through from higher energy prices into core inflation. And, the economy is bruised, but not yet really battered. I mean, this is a resilient economy, and I mean, it's kind of defied my expectations.
Can we just check the line quick and make sure this is Neil Dutta?
I honestly don't know if this is Neil Dutta. I was expecting a discussion about labor.
It's Neil?
I don't know.
It's actually Neil?
Maybe it's just simply a hologram.
Neil, this feels like a change. Is that fair?
Well, I mean, I'm a sell-side analyst, John. When the data changes, you have to change your view, or you start losing clients because no one wants to listen to you. So you have to kind of adjust with the times. And I think you've seen that. Look, I'm not the only one. You know who the other person is? Christopher Waller has changed his views. He's been kind of a little bit more, I guess you can say, sanguine. It doesn't mean that there aren't risks out there. In fact, I continue to see them. But I think for right now, you have to kind of tip your hat to the economy and say things are stable. We'll see where we stand at the end of the year. We will have fiscal policy transitioning from a tailwind to a headwind. The Fed is on hold. Labor market conditions, I think particularly wages, are still probably cooling somewhat. Right now, we're kind of in the throes of this spectacular AI kind of CapEx boom. But we see what the risks are, particularly overseas. But right now, I think if you're a Fed watcher, you kind of have to just watch and wait.
Well, Neil, Julian Emanuel, who was on earlier, basically said that we only have 2 more months where this economy could sustain triple-digit crude. And if you look out into July 4th, in the futures market, it's actually at $100. That's what they're pricing. Where do you see a breaking point?
Well, I think the important thing is right now the break is very linear in nature. I mean, I think over time, as people feel higher gasoline prices, remember, income growth going into this wasn't any great shakes to begin with. So we are going to see weaker real income growth. And that in turn, I think will, gravity will prevail and pull down real consumer spending. But that's still very much a forecast, not a present day reality. And given where inflation is, the economy breaking has to be a present-day reality. That to me is the primary tension right now. The Fed doesn't really have your back if you're an equity market investor. The Fed is basically waiting for the unemployment rate to rise before doing anything. So that's kind of where we are right now. But we kind of need to see it before they move.
A data-dependent Neil Dutta. Neil, good to see you, as always. Neil Dutta there of RunMac. To Neil's point, Governor Waller has changed his view somewhat. Neil's changed his view. Secretary Besson has seemed to have changed his view as well, saying that he's more understanding of a Federal Reserve if they keep interest rates on hold for the time being, at least for now.
That's what the market is coming around to. Bob Michael yesterday, similar kind of move. We were talking about rate cuts to start the year. Now he's saying, actually, it doesn't seem that likely. It does feel like this is a sea change, and it does feel like people have been surprised by the strength in the economy. At what point does the corporate spending from the big hyperscalers potentially triumph over the weakness that we would have been getting because oil prices are this high?
The bar for hiking is still high. Most people would agree that the bar for hiking is still high, but the bar got a little bit lower. And that's the development of the last 24 hours.
It's actually getting priced into the market. There's a 40% chance of a rate hike coming up through March of next year. Look, will they do it? Julian Emanuel says no way. At the same time, the fact that it's getting introduced in price action gives you a sense of what's going on.
And at the same time, oil prices just keep going up. Gasoline prices in America are going up. And what did Kevin Warsh say at the start of his hearing? Inflation is a choice. Well, if it's a choice, then he is going to be at the head of the Fed who could potentially work to bring that inflation down.
Do you know what else keeps going up? Stocks. Equities up again this morning on the S&P by 0.2%, staring down one of the biggest monthly gains we've seen on the S&P 500 since 2020, higher this month by close to 10%.
What did we get? Yes, we got the hyperscalers that beat expectations or met. You get some modeled performance just based on the CapEx plans, but you have Ford outperforming, Caterpillar coming out. I do think it's important to reiterate what we just heard. You talked about the headlines, John, the idea of the beat on earnings per share. Their machinery, power, and energy revenue is $16.5 billion. This is directly tied to the build-out of energy infrastructure and AI. That was versus an estimate of $15.4 billion. This is just massive stuff.
Some interesting moves this morning. Looking at dollar yen as well, 2% move, 157, some yen strength. We're on the brink of intervention, real threats coming from the Japanese Finance Ministry. We'll spend some time on that in the next hour. Up next on the programme, we'll catch up with Mossavar-Rahmani of Goldman Sachs, Clayton Seigle of CSIS, Mike Wilson of Morgan Stanley, the former Boston Fed President, Eric Rosengren.
Policy stance is in a very good place for us to wait and see.
I just don't see any need for the Fed to really change its bias or react in meaningful ways.
Odds of cuts later this year certainly should go down.
The market already took the easing bias out.
I don't expect any changes in rates this year. That's cuts or hikes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures bounced by 0.2% on the S&P 500 on the final trading day of April, looking for a gain this month of more than 9%. On the Nasdaq 100, up by 0.2%. In the commodity market, some stress building for 8 consecutive days coming into Thursday. A 30% move over that period on Brent crude. We pulled back by close to 2%. Brent crude this morning at 116, WTI at 106. Heading into this, central bank decisions galore in the next 60 minutes. The Bank of England decision just dropping. Interest rates unchanged. Up next, the ECB at 8:15 Eastern Time. Later, some economic data and Apple after the close.
Oil is doing a lot of heavy lifting in the wrong direction for these central banks. And one thing that Andrew Bailey said of the Bank of England was that there is a risk of material second-round effects. This is the fear percolating through markets. And all these people who believe that the Fed could previously cut rates significantly and other central banks as well are now coming around to the idea that maybe not, because right now we're dealing with an economy that can handle oil prices where they are. And potentially you could start seeing the trickle through in places like, hey, CapEx spending, but the likes of Meera that has to go up because of how high commodity prices.
We've priced in hikes at the Bank of England. We've priced in hikes at the ECB. We've priced out the easing at the Federal Reserve. And this bond market has responded accordingly in the past few weeks.
You're seeing yields at the highest levels, at least in Japan, going back to the late 1990s. If you take a look at Europe, you're looking at the highest levels going back to 2011, 2008 for the Bank of for gilts. At this point, when does that torpedo growth? When does that torpedo capital markets activity? Not yet. And that is where the second round effects could come into play if this tightening doesn't work as a lot of people expect.
We'll head over to Lizzie Burden outside the Bank of England in just a moment. Need to work through the latest in the Middle East as well. The latest reporting from Axios suggesting the president is slated to receive a briefing on new plans for potential, and I stress potential, military action in Iran. The latest from Axios this morning.
What was interesting, too, about the report is one option would be to try to open up the Strait of Hormuz in a military fashion, and that would require, one individual said to Axios, that would require boots on the ground. We just heard from the Supreme Leader of Iran, an individual that we haven't seen, but we've seen a few statements from, and says a new chapter of the Persian Gulf and the Strait of Hormuz is being written, and they're talking about how it's basically under new management when it comes to the Strait of Hormuz. That's the tolls and the fact that they have absolute, complete control over it.
Let's set up the next 60 minutes, and then we'll get to the Bank of England decision for you. Coming up this hour, in just a moment, we'll catch up with Mossavar-Rahmani of Goldman Sachs with more tech earnings on tap. Clayton, Seigle of CSIS as crude climbs through 115, through 120 at one point. And the former Boston Fed President, Eric Rosengren, with Chair Powell planning to stay on at the FOMC. Let's get to that Bank of England decision then. Crossing just moments ago, Lizzie Burden has the headlines. Hey, Lizzie.
Hey, John. Well, as expected, the Bank of England has held rates at 3.75%, but it's really the commentary around this decision that is in focus here. 8-1 was the vote split, as expected. The chief economist of the Bank of England, Hugh Pill, dissenting to hike rates now. He's worried about the second round effects, and a lot of emphasis on the second round effects in these new scenarios that the Bank of England has put out. So this is the first set of forecasts that we've had from the bank, the first complete set of forecasts since the start of the Iran war. And indeed, if we just go into what they say, in all scenarios, rates would be going up. Now, the Bank of England has maintained its guidance that it stands ready to act as needed. That's what they said at the March meeting. Remember, there was no press conference that time, but it set off a massive market reaction that the governor had to walk back. This time, they've scrapped the central forecast in favour of these three scenarios. No second round effects in scenario A, some in B. In C, they'd be material. And so you've got different members of the Monetary Policy Committee putting different emphasis on these scenarios. But if you look at it, in C, CPI would peak at 6.2% in the first quarter of 2027, unemployment at 5.7%. As I say, rates rising in all three scenarios, and different members of the Monetary Policy Committee emphasising which is most likely. But for Pill, the dissenter here, he says the risk of second round effects are skewed to the upside, and that's really what matters here when you're listening to him. Look at the market reaction. Interesting to see that gilt yields on the 10-year have fallen. We're down 6 basis points at 5.01%. So compare that to before we had higher gilt rates, yields. We were in a jittery market anyway. You'll note the reaction to the March decision. We're factoring the energy price shock. we're also factoring in the political risks here in the UK.
Are we on the edge of a policy mistake in Europe? Lizzie Burnham, thank you. We'll hear more from the ECB a little bit later this morning. These are central banks, and the market is pricing in hikes for the year ahead of both the Bank of England and the ECB. And to some extent, I think the words of Hugh Pill this morning, the chief economist at the Bank of England, validating some of that market pricing.
Saying ultimately he thinks they should hike right now. Just to note that in scenario C that Lizzie was laying out, they would say forceful action would be warranted in terms of tightening. So that would come with an inflation rate above 6%.
Here's the view on Wall Street this morning. Stocks looking for some direction as big tech plans another massive AI spend in the face of what could be tightening central banks worldwide. Joining us, Mossavar-Rahmani, the wealth management CIO and head of the investment strategy group at Goldman Sachs. Charmaine, it's good to see you.
Hello, thank
you for being here. Are central banks about to become a headwind to this equity market rally?
We actually had a very good exhibit on one of our client calls. If you look at the 21 past strikes that the U.S. has had on the Middle East or North Africa, up to 8 weeks after the initial strike, the equity markets have been up on average 4%. And that's exactly where we are. So everybody's saying, oh, the equity market is going ahead. How can they ignore the price of oil, whether it's WTO or Brent? What is exactly going on? Growth is still robust. Obviously, we're going to get Q1 numbers, but I think nobody's thinking that we're in a recession is imminent. And if you look at the earnings we've gotten, they've been incredible, right? Substantially greater than consensus. And this is a pretty significant, in terms of exceeding expectations, it's a pretty significant number. It's not like, oh, we exceeded earnings by 2%, 3%, 5%. It's double digit. And if you look at the number of quarters where we've exceeded expectations, the number of consecutive quarters, it's just incredible. And so when people talk about the impact of the war, we have said the U.S. economy is unbelievably resilient, and people continue to underestimate that. So as we look at this, I don't think anybody knows exactly how long this will last. If it lasts a lot longer and oil prices stay at these levels, then the economy will be weaker. And so the idea that people can raise rates in the face of weakening economy, especially in the U.S. when you have a dual mandate, I think we need to factor in a lot of uncertainty.
Do you think that there is a lack of logic when people say, well, oil prices are at this level, and you see still that robust growth in the economy? So that means that the inflationary impacts can get passed through much more directly and easily because of the CapEx spend, because of how well these companies are doing. Do you see that as a logical connection, or do you think it just hasn't been long enough with oil prices at this level?
There are actually 2 points. You're right. It hasn't been long enough. So that's number one, because if this war were to last and we see oil prices here, eventually we will get to negative numbers in the equity market. But for now, the idea that we're up 4 or 5% is actually totally in line with history. And from our perspective, one of the pillars of our investment philosophy is history is a useful guide. So first, we have that as the backdrop that we need to follow. The other thing that people need to think about is the energy intensity in terms of usage of oil is a lot different than the early 80s. So when we had the Arab oil embargo, then we had the Iran-Iraq war, we had the Iranian Revolution, prices skyrocketed. But at that time, the energy consumption in the U.S. in terms of barrels per capita per year were substantially higher. In fact, it was around, let's say, 30 barrels a year. That number is down to around 23, 24 now. So there's also a view that energy, crude oil, will not impact as much. Obviously, it will. Fertilizers, we hear about all of these things, but it has to last a while.
It does affect the cost of components, and we saw this with some of the hyperscalers reporting earnings last night. Meta, for example, increased their expected CapEx in part because of higher component costs, maybe also because of some of the transportation issues that people are experiencing. At what point does that become a sticking point, maybe not for the biggest tech companies, but for some of the tech companies out there that are facing an existential threat but are having to pay that much more to even play ball?
I think there is a big question mark about the returns to the CapEx for AI companies. The hyperscalers obviously have so much cash flow from other factors that they can do quite well. And if you look at their earnings, whether it was the latest reports or last year's, they're just been phenomenal. But the rest of the economy is actually doing quite well, and people underestimate, again, the resilience. If you think about oil production in the U.S., U.S. produces double the levels of Saudi Arabia. Right? It's just incredible. You think about natural gas. U.S. has become the largest exporter of natural gas literally in 10 years. far exceeding Qatar. So as we think about these factors, people need to think that the shock is not as great. And at the end of the day, both sides want to end this war. The question is, what is a respectable off-ramp for both sides? And I think the market is saying we will get there. Well, there'll be fits and start, escalation, de-escalation, and we're going to have to go through that. And that's why we recommend our clients stay invested. Don't try to time this market. Nobody can do that consistently very well.
But in the beginning, conventional thinking was 4 to 6 weeks. We're now 8 to 9 weeks into this war. How much longer, with these kind of elevated prices, do you think the economy could withstand? Julian Emanuel says July, and then things might start to break down. Do you have a date where you're looking at?
Not really, because nobody really knows, right? If you look at the probabilities, it's not as if it's so obvious how long this will last. I think we know both sides don't want it to last July and August.
Not the conflict. How long the economy could withstand triple-digit crude?
Well, in the U.S., we're just around triple-digit, right? And we've been here before, and prices lasted at these levels for a while. I don't think the economy is going to break. We had initially expected GDP to be around 2.3 when we started, then momentum 2.4%. Now, because of the war and oil prices, we've lowered it to 2.1%. But we have a very low probability of recession, even at these levels, if prices were to stay here. I think to say exactly, is it July? Again, if you believe the resilience of the economy and adjustments, and we're talking about the U.S. that has ample crude and natural gas, right? It's really the rest of the world. And if the U.S. is a big importer and less of an exporter, then not in terms of hydrocarbons and things like that, but in aggregate, the damage to the economy is going to be much less than it is, for example, to Europe or to China.
Do you think we're moving into a phase where the offset to equity risk is increasingly gold and commodities and not developed market bonds, which increasingly are subject to potentially spending issues, deficit issues, as well as just the natural inflation in the system?
That's a very good question, because all our clients are asking us, how can they hedge against the risk of war? And we tell clients that at the end of the day, the best hedge against inflation has been historically U.S. equities in aggregate. So in fact, that's why, again, we say stay invested. Gold is not a good inflation hedge and not a good deflation hedge. So the idea that gold is something you need to have in your portfolio is something we totally disagree with. We don't think it's really part of a client's strategic asset allocation. And tactically, we've actually said that when you see these kinds of price increases driven by central banks, especially initially by China and then countries like Turkey, Poland, clients shouldn't be caught up in the euphoria and the momentum of gold. And obviously, we've seen a pretty significant decline from peak levels.
Seen a big turnaround. Shamin, it's great to catch up with you. Thanks for being here.
Thank you.
Thank you. Shamin Mossavar-Rahmani there. Equity futures this morning, positive by 1/3% on the S&P 500. A bounce back here. A Bank of England decision just moments ago, falling short of some of the hawkish expectations. Very, very hawkish pricing in this market ahead of this decision. An 8-1 vote, to some extent falling short of that. That one vote, though, that one vote is that endorsement this market was looking for of a central bank that might be getting closer to hiking interest rates. But that's all we've got. And frankly, the 8-1 decision highlights how difficult this really is for England. Right now, the fact that they're talking about north of 6% inflation, at the same time 5.7% unemployment, that is uncomfortable. Some of the hawks just in a holding pattern at the moment. Yields pulling back on gilts so far this morning. Let's give you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump defending the U.S. blockade of Iranian ports, saying it's more effective than bombing the country. Trump rejecting the latest Iranian proposal to open the Strait of Hormuz and lift the blockade until concerns about Iran's nuclear program are addressed. Axios reporting the president will receive a new briefing on the situation today. In his final meeting as Fed chair, Jerome Powell announced he will remain on as governor after his term ends next month. Powell saying he felt he had no choice but to stay amid a series of legal attacks.
I'm literally staying because of the actions that have been taken. I had long planned to be retiring, the things that have happened in the last 3 months have I think, left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere.
The president blasting Powell's decision, posting, quote, Powell wants to stay at the Fed because he can't get a job anywhere else. Shares of Bill Ackman's Pershing Square down 18% in its market debut. The fund raised $5 billion in its IPO, falling short of the $25 billion it had originally sought to bring in. Ackman aims to build a long-term diversified holdings company such as Warren Buffett's Berkshire Hathaway. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. More from Vonnie later this hour. Up next on the programme, curbing the crude surge.
Nobody likes, of course, high prices in the short term, but they understand increased American energy exports, increased energy addition policies, lean into more energy production. That's what President Trump is all about.
Up next, we'll catch up with Clayton Seigle of CSIS, live from New York City this morning. Good morning. So here's the bounce. A little bit of a turnaround cross-asset. Let's start with equities. We're positive. Didn't do much yesterday. Positive by a third of 1% on the Nasdaq, up by 0.4. Lots of tech results we need to talk about. Let's turn to commodities. A turnaround there. 8-day streak of higher oil prices broken this morning. That's the longest daily streak going back to May 22. We're down by 2.7%. 115. Even with the threat, and I stress potential threat of military action in the Middle East, given the latest reporting from Axios, crude pulling back. That's notable. That's helping yields drop, just opening up some space for yields to pull back. 2s, 10s and 30s. 2s down 5 basis points, 10s down 4. And then this move in dollar-yen. Let's bring up the chart. Brutal stuff. If you're on the wrong side of this, dollar-yen, negative 2% in the yen's favour. The Japanese Finance Ministry with a range of headlines this morning. Tell you what, verbal intervention takes on a new twist from Japan. This is your final warning. Get ready. We're close.
Yeah, stay close to your phones because ultimately we might take action at any time. So I can just imagine the alarms people have set.
Yeah, that's not the trade you want to be on the other side of. This morning at least, dollar-yen, 157. Under surveillance this morning, curbing the crude surge.
The critical outcome here is that we end the ability for Iran to have a nuclear weapon. So look, we're going through a period of discomfort to solve a 47-year crisis. Nobody likes, of course, high prices in the short term, but they understand increased American energy exports, increased energy addition policies, lean into more energy production. That's what President Trump is all about.
It's the latest this morning. Crude hovering near 4-year highs as the US weighs new military options in Iran. Axios reporting President Donald Trump is preparing for a briefing with the head of US Central Command later on today. Clayton Seigle of CSIS writing global balances are heading for a 1 billion barrel shortfall, with fuel prices increasingly likely to hit corporate earnings, consumer wallets and GDP growth. Clayton joins us now for more. Clayton, and yet the blockade continues. How much storage do you believe Iran has left?
Hey, good morning. You know, it probably has several weeks worth of storage left, but I think that the market and observers are maybe over-indexing on how much pressure a potential shut-in of production is going to play in Tehran. I mean, they've had to pare back production and shut in wells in previous episodes when sanctions were really hitting hard, and they have had the ability to scale back up after that. So I think this kind of the story du jour that's making its way through markets, that it's going to result in some kind of permanent damage that they need to scramble to avoid, it might be a little bit exaggerated. But instead, we could really look at the effectiveness of the blockade in keeping those ballasting tankers, the empty tankers, from getting into the Gulf in order to serve as floating storage. So all of these things kind of go together in terms of their storage capacity.
But Clayton, if they're using these empty vessels to store some of these barrels, when they hit tank tops, what happens next?
So if they can't get more empty tankers in order to keep loading at places like Harg Island, then they will have to organize a program of turning down production in the fields. But remember, that's also what the other Gulf Arab producers have been faced with in the last couple of months. So Saudi Arabia, UAE, Iraq, Kuwait, they've all had to turn down production because there's nowhere to physically put the oil at the earlier production limits because it's just not getting out of the Gulf. So, of course, Iran is in the same boat as the rest of them. But the question is, can a production downturn be organized by the engineers, by the geologists to avoid any kind of lasting damage? That's question number one. And I think the answer is probably yes, because they have experience and track record of doing that in the past. But then the second question is, do the decision makers, do the powers that be in Tehran really care that much? I mean, these are the same people that went against their own population with a very severe crackdown recently. And so I'm not sure that they're going to be motivated necessarily by the long-term vision for Iran's upstream industry.
Right. We have seen Iran deal with that in the past. What about Gulf partners that are also dealing with potential shut-ins at wells?
And we've had more than 13 million barrels per day of oil production downturn during this crisis. And this is all because the Strait remains closed. So when I was looking at the blockade proposal a month or so ago, I think the idea there was it could really be a force for good just to temporarily level the playing field and to send the message to Tehran, hey, look, if everyone else's vital energy exports can't get to market, you're going to have a hard time getting yours out too. But then immediately use that opening to resume diplomatic negotiations and find a mutually acceptable off-ramp to this crisis so that the exports can resume and so that the global economy can rebound and be protected. But the Trump administration's handled it a little bit differently. They announced at the same time of the blockade being imposed earlier this month that it's going to stay in force until a final agreement is reached. So that's not really a temporary bridge. That's kind of keeping the chokehold on Tehran unless and until we have a final settlement. And apparently that hasn't played very well there.
Clayton, what does a mutually acceptable agreement look like that really removes the risk that Iran could do this again?
I think that the key point is that both sides are going to have to climb down from maximal positions. I mean, it can't be that Tehran has a complete chokehold over the world economy going forward. Exporters and their customers don't want to hear about a permanent tolling arrangement. So I think that they should make compromises on that front. From here in Washington, to try to architect a deal related to uranium enrichment that is even stronger than the previous arrangement, the so-called JCPOA that was negotiated under the Obama years, that's a high hurdle. So if both sides can just get their must-haves out of a diplomatic agreement instead of the nice-to-haves, I think that there's room for progress.
Clayton, appreciate your time. Thank you. Clayton Seigle there of CSIS down in the nation's capital in Washington, D.C. It's difficult to please everyone because so many parties are involved. And it's not just the U.S. and Iran. It's nations across the Gulf as well.
Even if you get to a place where suddenly people can go through the Strait of Hormuz, but Iran has the ability to potentially reverse course, what kind of premium starts getting baked into oil prices? And you're going to get a lot of those pipelines that are being diverted in other directions from the other Gulf regions just as quickly.
Are shipping companies going to have the confidence to go through the Strait of Hormuz, even if the United States says we feel like it's safe and it's open? It took about 6 months for the Red Sea to get a little bit back to a normal cadence. And that was when the Houthis, this is on a totally different level when it comes to Shahadi drones and the IRGC on speedboats.
I remember when it opened 2 weeks ago. Do you remember that? 2 Fridays ago, Strait of Hormuz is reopening.
Verbally opened, not physically opened.
Of course. And then it didn't at all.
People are brilliant because if you go online, there are all these people. There's actually a Google review for the Strait of Hormuz, and it has 1 star.
Seen that.
And it has, it
pretty
has the
high,
dates.
1 star.
Well, it's because you can't get lower than that. And it's Monday, maybe open from 8 a.m. to 8 p.m., Tuesday close, Wednesday close, etc. And now I can just imagine it has a big banner over it saying...
It's farcical, isn't it? Yet it's really, really serious.
But that's the whole thing, exactly.
And you've got countries across Asia getting crushed by this because they haven't got access to the energy. It's not just a price story. As we've said repeatedly, it's a shortage story.
We're seeing this come through in the economy and the economic performance. Europe underperforming today, and we see that consistently as a result of this.
Underperforming, and yet some central banks still at least discussing the potential for rate hikes, which just seems crazy.
One mandate, not a dual mandate, and is that going to change?
The potential for second-round effects when your economy's not that strong, though. That's my struggle.
Great question.
It's my struggle. Mike Wilson,
John for ECB,
of Morgan Stanley, up next.
I can see how young.
The Bank of England decision just behind us. The ECB decision ahead of us at 8:15 Eastern Time. 30 minutes later, a news conference with Christine Lagarde. We'll take some of that right here on Bloomberg TV. After that, we'll get some economic data. Jobless claims coming at 8:30 Eastern Time. A host of other data points as well. Then after the close, we get numbers from Apple to wrap up a big week for tech results. Equity futures so far this morning. Your scores look like this. Higher by 0.4% on the S&P 500. Up nicely on the Nasdaq. Up by 0.6 to add to a pretty impressive monthly gain so far. I think of more than 14%. which would be the biggest monthly gain going back to, I believe, April 2020. And we saw some big gains back then.
Yeah, if you take a look at some of the performance over the past month, April is poised to be the best month for the NASDAQ 100 since 2020. The S&P tech sector is poised for the best month since 2002. And if you look at semis, you got to go back to 2000 to get to these levels.
Crazy.
So it's, driven by a particular area, let's be honest. You've been pointing this out, though. Energy stocks, the worst performers.
They've done nothing.
I don't understand this. I mean, we've been talking about
Chevron,
this.
done nothing for 2 months.
They've actually lost. I mean, this is sort of the question. What are we looking at here?
Crazy, isn't it?
Yeah.
Even with these moves in crude, close to 115 this morning, pulling back to 113, briefly through 120. We had an 8-day run of higher crude prices on Brent, up over the period by 30%. Declining this morning on WTI, we're down by 2 to 3 percentage points. That's unlocking this move in the bond market because yields yesterday, 10s and 30s, closed at the highs of the year, pulling back from those levels, down 4 basis points on 10s, 439, down 5 on 2s to 389.
At what point does it start to bite into some of the enthusiasm that we're seeing in markets? I feel like a Debbie Downer this morning when I mentioned that, because when we talk about it to analysts, they say, we're managing just fine and it's not going to stay here. But right now it does feel like we keep creeping higher in the developed markets. And at some point, when does that start to put a crimp on some of the capital markets?
Just the chorus in the control room. Only this morning. Just this morning.
Normally I'm really optimistic. I mean, come on.
So upbeat.
I mean,
on a daily basis.
Well,
it's overwhelming.
Normally? You should listen to my conversations at home.
I imagine.
They sound
What was it about last night at the dinner table?
Human versus AI and
humans
the
just won't have a role, it's over.
The offspring
computers are taking over.
Long AI, short humans.
The Terminator is happening at our house.
Does the mood get better through the day and then decline again at night? Is that how things work?
It depends. Again, do me, but with a smile.
Okay. As we count you down to the open about, I love it. 2 hours away from the cash open. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We're getting a wave of earnings this morning, and we start with some standouts in the pharma sector. Take a look at shares of Eli Lilly, up more than 7% in the pre-market after it raised its guidance due to booming demand for those weight loss drugs. Lilly saying that its latest one, that pill, is off to a great start. Merck also, it was a beat there due to strong demand for its newer drugs as its older ones face expiring patents. Moving on to Royal Caribbean, those shares also rising 7% in the pre-market. Investors looking past weaker guidance due to higher fuel costs tied to the war, and they're clinging on to this. Royal saying that after a dip in March and April, bookings have recovered and are even running ahead of last year. And we end on Caterpillar, those shares also rising in the pre-market, up nearly 5% after a massive beat as this legacy industrial name becomes part of the AI build-out. Caterpillar seeing huge demand for its generators and gas turbines, of course, part of the AI data center build-out. John?
Yahara, thank you. Thanks for the latest. That stock higher by close to 5%. On our radar this morning, Alphabet surging as AI demand fuels a cloud computing boom. Meta lagging behind after a massive budget hike weighs on the stock. The 4 companies, including Amazon and Microsoft, are expected to spend more than $725 billion in 2026. Elsewhere, crude hovering near wartime highs. On reports, the U.S. is weighing new military options in Iran. Axios reporting this morning that the president will receive a briefing from the CENTCOM commander later on today after rejecting Tehran's latest deal. And finally, the president blasting Jay Powell's decision to remain with the Fed after his term as chair ends, writing on Truth Social, quote, Powell wants to stay at the Fed because he can't get a job anywhere else.
And we've been talking about how that's really tame. I mean, ultimately, we were talking about potential war in the court system. Does this matter? And ultimately, what is the best strategy for everyone moving forward? What does it mean for him to take a low profile and to stick around?
To just move forward and move on, I hope. I think that is the best strategy.
Well, that's what a lot of people would suggest, but what is he waiting for? Is it the Lisa Cook or is it something else? And when can we move past the Bachelor?
It could be the Fed Inspector General report. It could be what's going on with the Supreme Court and Lisa Cook's seat. I think Neil Dutta hit the nail on the head when he said the White House hasn't handled this process normally, so why should Powell be expected to handle this process normally? I do think it's interesting, though. Powell's a dove. Does anyone think he's a hawk? Maybe the White House is actually like, whatever, at least he's going to vote in our favor.
He had rates at zero at multi-decade lows when inflation was at multi-decade highs. It's hard to call him hawkish.
My favorite part is that talking about Republicans and how this undermines the Republican-appointed nominees to the Fed. Well, guess what? Chair Powell is a Republican nominee. In fact, it is President Trump's own nominee. So, let's really park this. And by the way, Kevin Warsh is an inner hawk, so let's be clear about that.
I was hoping for that follow-up question. But, sir, Isn't Jay Powell the president's own nominee, but we didn't get it?
Well, obviously, you watched the channel that interview took place on, so you expected the follow-up. I mean, come on, it's fairly predictable stuff.
It was an easy follow-up. I just wanted to hear what Besson had to say to it.
Follows a script on the hyper-partisan news networks in America. You know this. We'll catch up with the NEC director a little bit later to talk about some of these issues. Kevin Hassett joining us at 9:30 Eastern Time. Let's talk about tech. 4 of the Mag 7 beating expectations and planning a more than $700 billion AI spend. Mike Wilson, Morgan Stanley CIO and chief equity strategist, writing, "Our factor work shows the market is broadly rewarding higher capital spending as cyclical and structural forces encourage CapEx." Mike joins us now for more. Mike, good morning.
Good morning.
Can you build on that a little bit more? Because we got some pushback to the likes of Meta. How universal is that take?
Yeah, I mean, this has been a call we've had for quite a while, and this is part of the rebalancing thesis. I mean, the administration is encouraging more CapEx, and the good news is that the market is rewarding more CapEx, not just with the hyperscalers, but more broadly. And I think this is an interesting question to think about. First of all, 4 weeks ago, we did step in pretty aggressively on the hyperscalers. We thought they sold off way too much, and people were kind of punishing those stocks in a way that they got very, very cheap. And now they've rallied quite a bit. Now, if you look at the other stocks, that benefit from CapEx, they're also working. Some of the industrial names, some of the parts of the economy that are going to see this. That's part of the big, beautiful bill. That is the story, right? More investment, less consumption to get higher productivity. So this is a broader thesis than just AI CapEx. I think it's really important that companies continue to allocate capital in a way that leads to higher productivity. That's the strategy. That's what we're trying to achieve.
That's kept you bullish throughout all of this over the last 2 months. We've all been following your research. How insulated are we in this equity market, not the economy, the stock market, from what's happening elsewhere abroad in the Middle East?
Well, look, it comes down to earnings. I mean, if companies are growing earnings 15, 20%, and the forward earnings expectation is 25%, they're not going to be laying people off or restricting themselves on capital spending or doing things to make their businesses grow. One other thing, a theme that we've been talking about for years is this inflationary regime, okay? So if you're in an inflationary regime and the Fed now has real rates close to 2%, which is, kind of restrictive in some ways, okay, we got to find a way to grow, like organically. And so this is a real change over the last 15 years when it was all about financial repression, buying back stock, borrowing at negative rates. Companies got to invest real capital, take real risk to generate real returns. So who do you want to bet on? You want to bet on the companies that are high quality, that have done that in the past, have generated high returns on capital in the past.
Does this still support the idea of a broadening out trade, given the fact that it is the biggest companies, and a lot of the big earners have been the hyperscalers that have the ability to invest, but the consumer on the margins, I hate saying this, but is being more choiceful, choosier, pickier, because they don't have as much discretionary spending.
That's right. And so, I mean, the consumer statements have not performed well in the last month or so. So, in other words, the market, everybody says, oh, the market's ignoring these high oil prices. I don't think so. I mean, you look at some of the consumer retail names, you look at the airline stocks, things tied to higher oil prices have underperformed. So the market has just moved away from that for areas that are somewhat insulated, to John's question. All right, so we still think the broadening story is happening. And the reason we're saying that is because the earnings story is telling us that. Earnings growth for the median stock in the Russell 3000 is now well into the double digits. That's the first time we've seen that since 2021. That's why we had the broadening call for this year. So that, to me, that's the opportunity now. Everybody's crammed back into sort of the same name, saying it's only a handful of stocks. No. There's a lot of companies, businesses that are doing quite well in this environment.
When would the bond yield backdrop start to worry you, given the fact that we have seen the long end of the yield curve creep higher?
Right here. It's 440 has been, we've kind of rejected that a couple of times in the last few months. And we've seen the Fed and the Treasury intervene in both cases, right? Jay Powell with a little bit of dovish rhetoric on the 30th, the Treasury doing bigger buybacks, more bill issuance. They have these gains. We've written about this extensively. What I'm watching is two things. 450 on a 10-year. We've established that in the last couple of years. We're not quite there. But more importantly, bond volatility. Okay. So the MOVE index, was up around 115 back at the end of March, related to oil prices and the Fed getting a bit more hawkish. And then sure enough, the Treasury and Fed stepped in, and now that's down to like 70. That's totally cool. So I'm watching bond volatility. If that starts to pick up with rates at 440, 450, we could have a decent correction of, say, 4 or 5%.
We're looking at corporate credit as well this morning. This headline just crossed in, Lisa. One for you. Meta kicking off a 6-part U.S. high-grade debt sale following earnings.
And this is to be expected, considering the fact that they're hiking the costs. Will debt investors like the fact that that spending will be going into not just more capacity, but higher prices because the commodity costs are increasing? Are people getting the bang for the buck?
So, Mike, you talked a lot about earnings let's talk about the P, the price, and the multiple. What's the multiple that these companies deserve now, given how different they are this morning to how they were 10 years ago?
Well, I mean, they're spending more money, to your point. So the multiple has come down. You know, one of the calls we had this year, which I think kind of got lost in the shuffle, everybody was sort of saying, oh, I can't believe the stock market's only down 6 or 7%. You know, this is ridiculous. The market's wrong. Well, first of all, the market's never wrong. Okay, you're wrong. Okay, and what was going on is that the PE multiple was down 18%. Okay, 18%.
A lot of compression.
I mean, think about that. 18% PE. That's as bad as last year going into Liberation Day. That's what we typically get in a recession. And earnings were growing 15% year over year. So we think the market, once again, fooled a lot of folks. It had its correction under the surface. It did a lot of good work. And that's why we got more aggressive towards the end of March, saying 18% is enough. I didn't expect us to rally like this, by the way. I'm not taking credit for that. But the entry point, I think, was pretty easy to kind of see back in late March.
Can we finish on energy?
Yeah.
We were mentioning that Chevron, Exxon, they've done nothing over the last 2 months. Since the end of February,
that's right,
pretty much flat. What's the story there, and what would you do with that sector at the moment?
Well, just change your start date. Since January 1st, I mean,
big first quarter.
They're up huge. And so, I mean, once again, equity market, you know, is really smart. So the oil stocks started really working the day that we did the Venezuela extraction of Maduro. Okay, and it was right. And oil services stocks. And they had a massive move, 30% relative outperformance. And they literally topped the day that, you know, we attacked Iran. I mean, that was the day they topped on a relative basis. We wrote about that. So it's one of the reasons we got bullish on the market was we said, okay, market's telling us that oil prices are going to be lower in the future, right? The spread between Brent and WTI, we wrote about that. And then the relative underperformance of energy stocks. That's the leading indicator that tells, and I'm still confident about it. That's why if energy stocks started really outperforming, I'd get worried that maybe oil prices are going to be higher in the second half. So, look, I have an easy job. I just let the market tell me what's going to happen.
I feel like you're having a good year. You feel like you're in the groove?
Yeah, I feel I'm in the groove. Exactly. Right. I feel like I'm in the groove. You know, I'm sure that'll change again. It's kind of like a golf game, you know.
Yeah, I was going to say, it feels like sports. You know, when things are going well, you can like see the ball just a little bit better, a little sharper.
You wake up and you just have that coordination, and then days when you wake up and you walk into a wall. I get it.
Financial markets feel like that sometimes.
I mean, it's true. It's sort of the days that things are lucid. The idea that the market is smart and it's sussing something out. I think it is telling, though, that oil stocks are down. And the idea here of what that tells you going forward about how long this is going to last. When does that pivot, right? I mean, I guess that's the key question.
Mike, it's good to see you. It always is. Thank you, sir. Great calls recently. Mike Wilson there of Morgan Stanley. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The longest partial government shutdown in history is a step closer to coming to an end. The House has approved the first part of a two-part plan to reopen the Department of Homeland Security. Speaker Mike Johnson is now eyeing a separate bill that would finance the parts of the department outside ICE and Border Patrol through September 30th. Shares of Ford lower in pre-market trading. Ford CFO Sherry House telling Bloomberg's Romain Bostic that rising commodity costs will weigh on earnings.
The forward curves are still holding that this Middle East situation is going to be more on the short-lived side. You know, as a result, at this point in time, we are believing that there's going to be some recovery as we start to exit Q3, as we get through Q3 and Q4.
Ford also boosting its full-year profit outlook, driven by high demand for pickups and SUVs. Amazon is considering a reboot of The Apprentice with Donald Trump Jr. as the host. The Wall Street Journal reporting discussions are in the early stages, and Amazon has not yet approached the Trump family. If the show gets made, it would appear on Amazon's Prime Video service. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. That sounds super early, given that the family's not been approached.
No, but it sounds funny. Would you watch? I think I'd watch an episode.
I think obviously I'd tune in.
Yeah.
You know my taste in TV when I'm not at work. It's the kind of thing I'd probably tune in for.
It's currently happening at the Federal Reserve. I mean, it's still ongoing, so whatever.
Would you watch?
I think this is a marketing play for Amazon.
Bachelorette's
Good
not
job.
on at the moment on ABC.
Oh yeah, that's what I do. I
Also,
go home, watch
Trump
Bachelorette with the family.
Trump recently went down memory lane and truthed out his high ratings of The Apprentice. So I don't know. I think he would encourage Junior to do this.
Up next on the program, an insult to the Federal Reserve.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh.
Up next, we'll catch up with the former Boston Fed President Eric Rosengren, live from New York City. You're watching Bloomberg TV. Overnight, things weren't looking great. You had crude pushing 120. You'd just seen the 10 and 30-year yield stateside close at the highs of the year. And the tech story was mixed. It was pretty mixed, with the likes of Meta getting slammed pretty hard. But since then, things have recovered somewhat. Equities are up by 0.4%. The Nasdaq's higher by 0.5%. In the commodity market, despite some, let's just say, not encouraging headlines coming from the Middle East, Brent is lower, not higher, down by 4%, following 8 consecutive days of gains for Brent crude. We're down to 113.58. And when you take that picture and plug it in and fold it over to what's happening right now in the bond market, yields are lower and not higher. They're down 5 or 6 basis points at the front end of the curve and down 3 looking further out on 10s.
I wonder if there's a regional bias. It seems like when trading is open in Asia and Europe, which is being much more significantly affected by some of the shortages, people feel a lot worse. And then when they come to the United States, based on all the guests that we've had, things are great. CapEx is booming. AI is going to save the world. And it feels like there's just such a different tone with the focus on earnings that people kind of look at all of the bright sides rather than everything else.
It's a pretty impressive stimulus program coming from 4 of the biggest companies on the planet, isn't it?
100%. You've got corporate stimulus instead of fiscal stimulus. So you've got both, frankly. So that's the reason why there's strength.
Yields down this morning, down 5 on 2s. The 2-year, 3.89. Under surveillance this morning, an insult to the Federal Reserve.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh, Mickey Bowman, and Chris Waller to think that these other Republican nominees do not care about the institution of the Fed, and that he alone can maintain the integrity of the Fed.
So here's the latest this morning. President Trump criticizing Jay Powell's decision to remain at the central bank after his term as chair ends, claiming he wants to stay, quote, because he can't get a job anywhere else. The former Boston Fed President Eric Rosengren writing, Powell views the legal actions against himself and others are intended to influence the vote on monetary policy. Eric joins us now for more. Eric, welcome to the programme. You, of course, sir, are entitled to your opinion. Do you believe this is an insult to other members of the Federal Reserve?
I do not. I think it is a reflection of the legal attacks on both the chair and one of the other governors. And as a result, it was intended to influence monetary policy, and he's standing up for the institution. So I think it's probably not what he wanted to do. My guess is he did want to retire. I'm sure his family would like to start seeing him again. He's been working very hard for 8 years, but I think he's doing it for the institution.
Eric, with that in mind, what kind of institution do you think Kevin Warsh is inheriting here?
I think from the new chair's perspective, it's a challenging environment. First of all, we've had a bad inflationary shock with the war in Iran, and we're about to get PCE core inflation, but I expect both the total and core to be up a fair bit. It's going to be over 3% for the core PCE inflation, and that's very high relative to a 2% inflation target. So a new chair who may have been hoping to lower rates, I think is going to face a committee that clearly is not as interested in lowering rates at this time because of the inflationary shock that we've had and the fact that the Fed's missed its inflation target for the last 5 years. So I think there are a number of members that are quite concerned about what's been happening with inflation. There were 3 dissents of presidents for the language that is viewed as a bias towards easing. There was one governor, Governor Myron, who would have preferred to ease, but he's wanted to ease at every single meeting. So I think it's a very split committee, and I think that's challenging because Kevin Warsh needs to get a majority to get whatever policy he wants through, and I think there's an unusual level of dissent at this time.
Eric, were you surprised that 3 members dissented in order to move to a different type of language, symmetric risk of a rate hike or a rate cut at another meeting in the future? Or are you surprised that more people didn't get on board with a similar type of move?
A lot of people don't view dissents as being used on leaving language unchanged, since it's the language that if they found acceptable 6 weeks ago, you have to think there's a pretty significant change to dissent over not changing the language. That being said, the 3 dissents against the language, I think, have all highlighted in their speeches their concern for inflation. And I think it is significant that it's Chair Powell's last meeting as chair, and as a result, I think they're signaling to the incoming chair that as voting members, they're going to be resistant to a policy that tries to, in their view, ease in a way that isn't consistent with how the economic outcomes have been coming out.
Eric, what does a low-profile Governor Powell look like to you?
I think he comments on data and keeps his views largely to himself, but he's still a voting member. His vote's going to be recorded. I think he's going to vote the way he thinks he should vote. Obviously, it's going to be awkward for Kevin Warsh if he starts dissenting along with a number of other individuals against the policy, or if Kevin actually can't get the votes to do the actions that he wants to take. So I think it is challenging, but I don't think it's something that is that difficult to manage if he has a clear understanding of where the consensus on the committee is. I mean, he leads the committee, but he has to convince people that his views are the appropriate ones.
Eric, I think that's the important point. Can you keep a low profile if you're willing to dissent with the chair?
I mean, I think he's hoping he doesn't have to dissent, that the recommendations are consistent with the policies that the framework document and the committee has long had. But I think if, for example, there was, I don't expect this, but if there was at the first meeting, a move to try to dramatically ease, I think there would be a lot of people that would be opposed to that. And there might not be the votes, including with, former Chair Powell at that point. But I don't expect Kevin to do something that dramatic. And I think he can count the votes. And I think more than likely we'll see that former Chair Powell and the new chair end up voting together in most instances, if not all instances.
We'll see if that's the case. Eric, thank you, sir. Appreciate your opinion this morning. Thank you. The former Boston Fed President, Eric Rosengren, on the future of a low-profile Governor Powell.
Which hopefully means Jay Powell that doesn't have to dissent against.
Hopefully. Imagine how awkward that would be.
That would be very difficult. That would be considered high profile in a significant way. At what point, though, we were talking about this yesterday, does Jay Powell sticking around give Kevin Warsh some cover in some ways, some credibility?
At least for now. At least for now. We'll see how this breaks. Up next, we'll catch up with Meera Pandit of JPMorgan Asset Management, Pooja Kumra of TD Securities, Jonathan Pingle of UBS. The ECB rate decision in the next hour. The third hour of Bloomberg Surveillance just around the corner.
It's all about the tech sector within the equity market.
We might be a little bit overbought here.
You have very strong sort of earnings fundamentals underpinning things.
Everyone is looking to make sure that this growth is still as strong as it has been.
The outlook still is optimistic.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. And your price action of scores look like this. Equity futures adding to gains, up by 0.4% on the S&P. Likewise on the Nasdaq. A turnaround in the commodity market. Crude trimming some of this week's gain. We're down by 2% on WTI. Brent crude down by 3.4%. Heading into this in just a moment, an ECB rate decision some 15 minutes away after that economic data, jobless claims, at 8:30 Eastern Time.
We'll see the division between Europe and the U.S. in some of the data that's coming out, as well as some of the rhetoric from the central banks. Right now, you've got European central banks that are facing off with much more of a challenge to a mandate that is singular. It isn't a dual mandate like in the United States. On one hand, they are seeing the weakness come through their economy. At the same time, inflation is that much higher as a result of oil prices. Can they hike into a situation like this, given the fact their one mandate is inflation, but if they had a dual mandate, it would be screaming something perhaps a bit different.
It's the communication dance. You want to anchor inflation expectations, but you really don't want to hike interest rates. And I get the sense from all these central banks, particularly in Europe, the ECB and the Bank of England, that that's the situation, that's the tension that they're currently facing.
At a certain point, if you see your economy deteriorating and unemployment going up, what do you do? How do you respond? Do you change your mandate? Right now, the Bank of England voted 8-1 to hold rates where they were, but they indicated that they could be hiking materially Does Christine Lagarde say the same thing? I'm looking for the color of her scarf to give some indication.
Is that what people do? We used to do that with Draghi and ties.
I think we need to start a scarf
and brooches.
And brooches,
Scarves
yes,
and brooches.
exactly what it is.
Okay, now typically I wouldn't try and mislead the audience and say, watch the news conference, it's going to be really interesting. The ECB is never really very interesting, particularly the news conference under Lagarde.
But
this one could be slightly different because of the situation they're in and the challenges they face in the Middle East.
How does she message this, given the fact that she has to signal a desire to anchor inflation expectations? But already yields are so high, number one. And number two, the data coming in weaker than expected just this morning, growth coming in weaker than expected, CPI on the margins coming in line, but a little bit higher in certain areas. It gives a sense of their conundrum.
Europe is struggling. First it was Asia, now it's Europe. They're struggling, we know, with jet fuel. Petrol prices are going up. They are more reliant on all of these imports from the Middle East. We spoke to the U.S. Energy Secretary this week, who is in Croatia. They're dubbing them Trump peace pipelines, but what they're talking about is just more LNG going to Europe. Second shock after Russia's invasion of Ukraine. Now they're doing with the Strait of Hormuz being closed.
So that's the schedule for this hour. So at 8:15, we'll get an ECB rate decision. After that news conference wraps up, it starts at 8:45. We're going to catch up with this guy. I think an important conversation on the Federal Reserve and the backdrop, the economic backdrop, given the threats we see in the oil market. Kevin Hassett, NEC Director, 9:30 Eastern Time, an extended edition of Bloomberg Surveillance right here on Bloomberg TV.
With gasoline prices near the highest levels that they've been going back a number of years, and this fear that maybe this will impede consumer spending, how does he dovetail both an argument for a Federal Reserve that's going to cut rates with an economy that is strong and delivering above average GDP growth? It is an uncomfortable message to deliver.
Looking forward to that conversation in the next hour. This hour, we'll catch up with Meera Pandit of JPMorgan Asset Management, with oil pulling back from wartime highs. Pooja Kumra of TD Securities, with a rate decision looming from the ECB. And Jonathan Pingle of UBS, breaking down the latest round of economic data. We begin this hour with stocks edging higher on easing oil prices. Meera Pandit of JPMorgan Asset Management writing oil at 110 to 120 for 6 months could have a 4 to 6% hit to EPS, but that would still leave us with double-digit earnings growth. Meera joins us now for more. Meera, good morning.
Good morning.
It's good to see you. Break it down. Where's that earnings growth coming from right now?
Look, if there's a war, nobody told earnings. That is one area of the economy where we haven't seen a significant decay in light of expectations. And even with some of the expectations that you just highlighted from our various equity analysts across JPMorgan, the range is still pointing to potentially double-digit growth. You started off the year with expectations for 15% year-over-year growth. That's gone up to almost 19%, 18.5%. So you've continued to see those upward revisions. Now, some of that is energy. A lot of that is tech, still being very resilient around that secular story. So we have a lot of buffer here when it comes to profits. And I think that's why, even as yields rise, you're not necessarily seeing stocks react.
You alluded to it. If I strip out a couple of energy companies, a couple of tech firms, does it still look as impressive?
It looks slightly less impressive, but nonetheless, I mean, that earnings story is getting very concentrated, so we do need to be mindful of that. But it is still broadened out overall. So if you look at the overall Mag 7, that in and of itself is a concentrated story, a lot of that around semis. You take just one of those Mag 7 companies out for this quarter, and that 22% growth rate falls to about 6.5%. Which is not great news when we think about the diversity of earnings growth within the Mag 7. But if you look at the S&P 493, you're still seeing double digits there. You strip out any other semi from that 493, and you're still just right around that double-digit mark. So you do see some broader contributors here and some other different sectors that are participating. A lot of them still linked to AI, but at least now it's not AI in one or two companies. It's AI kind of permeating through the system.
Is this backward looking? Is this ignoring the oil prices that we see now, should they persist for another couple of months?
Well, a lot of those estimates that we cited are assuming that oil prices stay at these elevated levels for 6 months' time. So it does assume a more extreme scenario. And again, even if we add a few percentage points to that, the buffer is so strong. And again, this secular growth around AI is so strong and broadening out that it will take more of a shock. And I think what's been interesting is this rolling 4 to 6 week timeline where it seemed like in the beginning, if we get to April, mid-April, and the Strait of Hormuz is still closed, we're going to be in big trouble. And that timeline keeps getting pushed out. So clearly the economy, the markets, earnings overall are a lot more resilient to oil shocks than perhaps we originally expected.
I love this comment. You know, just it needs a different kind of shock. What other shock do you need? You have your inflation shock, you've got your geopolitical crisis, and now you've got a potential rate shock. Could some of the moves that we're seeing in the bond market serve as perhaps a trigger to change this picture?
If we see rates move a little bit higher, and if that's because of some changes around Fed expectations, that's typically what we do see unseat the market. If all of a sudden a hike becomes a very real probability, then that is going to be very much a troubling signal for the markets, not necessarily just where yields are, but what that signals about monetary policy. But I do still believe that from a Fed perspective, the next move is more likely to be a cut than a hike. We're in a very different situation than we were in 2022. Obviously, the starting point from inflation and the direction of travel is likely different than it was in terms of intensity back then. But you also have a consumer that's a lot weaker. The excess savings has dried up. The savings rate itself is depressed. You have a labor market that's not particularly strong, wage growth that's moderated. And when you look at expectations around inflation, the fear here is, does headline feed into some of these inflation expectation measures? But you look at five-year forwards, you look at five-year break-evens, they've increased about 15, 20 basis points since the war broke out. So a little bit of pressure there, but nothing that's running away here. And I think ultimately what might happen, not only here in the U.S., but probably overseas if we think about Europe, is that higher headline inflation, because people are spending more on gas and food, starts to feed into core, and that actually keeps a bit of a lid on core because people are cutting from other areas.
But you say it could peak around 4% this summer, inflation. So how can they cut in that environment?
Well, I don't think the cut is on the table necessarily for this year. Maybe at best December, depending on how things play out, probably pushed out into 2027. But if we think about how we get to 4% back to the twos by the end of the year, probably the upper twos, well, we have a couple of different factors here. You have a bit of the flip side of energy prices that we do think will subside, maybe not all the way back down to where we started the year, but make some progress there. We're seeing that the tariffs will likely start to see a bit of that draining out further, the flip side there. We've had less immigration, so less demand to the overall economy. You continue to see rents soften, so we could very well be in a position where that inflation rate starts to come back into the 2% range, which means the Fed still has to wait and see, but it puts them in a better position by the end of the year to think about cuts for next year.
We spoke to Eric Rosengren moments ago, former Boston Fed president, about Chairman Powell staying on as a governor. What kind of institution is Kevin Warsh inheriting here when he takes over in June?
When you have Chair Powell staying on, he's certainly very much emphasized the point about the legal actions against the Fed and wanting to maintain the sanctity of that institution. I think the role he'll actually play on a day-to-day basis is a little bit more moving from your high school principal to your guidance counselor here, where he's going to try to help build some consensus and, certainly really try to protect the institution. But I do think that, look, the consensus building is an important aspect of the Fed, but maybe we had a little bit too much consensus building in the earlier part of this decade that could have helped prevent a policy error had there been a little bit more debate. So I do think that the debate element that Warsh will infuse into this committee is probably going to be a good thing when we think about the two-sided risks here.
Meera, it's good to see you. Thanks for breaking it down. Great summary. Meera Pandit there of JPMorgan Asset Management. I welcome it. We've complained about it for ages. The groupthink of the Federal Reserve, the lack of groupthink in the last 24 hours was pretty welcome.
Yeah, I mean, look, this was exactly what Kevin Warsh said he wanted. Can we give a victory lap to Meera Pandit? Moving from principal to the guidance counselor. Yeah. That is an analogy that has so many wonderful ways to play it that I plan on really.
Who do you think spends more time in that office of the Federal Reserve? Got any thoughts? Don't want to answer right now.
What, me?
Yeah, who would spend more time in that office seeing the guidance counselor?
Oh, among
the FOMC members.
Oh, yeah, I can. Oh,
yeah.
Yeah.
Exactly.
Okay.
All right, let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Stellantis shares sliding as investors look past a return to profit, questioning the sustainability of an apparent turnaround. Despite improved sales, analysts warn the numbers were padded by price cuts and a one-time €400 million tariff refund. The U.S. war in Iran has cost $25 billion so far, according to a senior Pentagon official. The cost includes spending on Operation Epic Fury, with most of it going to munitions, as well as operations, maintenance and equipment replacement. The White House expressing opposition to a plan by Anthropic to expand access to its Mythos AI model to about 70 companies and organizations. Sources telling us here at Bloomberg, officials are concerned the company lacks the compute power to guarantee security. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie a little bit later. Up next, the morning calls. Plus, the latest rate decision from the ECB. We'll break it down with Ollie Crook over in Frankfurt. We'll catch up with Pooja Kumra of TD Securities in just a moment. From New York City this morning, good morning. Equities doing better and better. Near session highs up by 0.5% on the S&P. The Nasdaq higher by 0.6. That's the price action. Here's your morning calls. First up, JPMorgan downgrading Meta to neutral, citing concerns about the company's massive AI spending plans. That name's down by 9%. Your second call from TD Cowen raising its price target on Alphabet to $450, seeing an inflection point in its monster cloud results. That stock is up 8%. And finally, Bank of America raising its price target on Amazon, anticipating more optimism on AWS capacity returns. That stock is up by 3.5.
Yeah, just important to note that Amazon's actually the biggest winner so far this year, up 14%, as it turns to more chip manufacturing and building out some of its cloud. I remember last earnings season, we were really skeptical of Amazon because they were announcing this huge CapEx spend and they were behind, and people were saying, they're behind, they're never going to catch up. Well, guess what? They're catching up, and they're catching up fast, and they're being rewarded for it.
This is what's insulating this equity market from some of the drama elsewhere. Let's get to some of the drama elsewhere. Another central bank decision, this time from the ECB, the European Central Bank, keeping interest rates unchanged, but some nuance here and some headlines we need to work through. So let's head over to Frankfurt at the ECB and catch up with Bloomberg's Ollie Crook for more. Good morning, Ollie.
Yeah, good morning, Jonathan. We're getting, as expected, the rate decision from the European Central Bank, leaving rates unchanged. This was never really regarded as being a live meeting for the European Central Bank. But what we're getting here from the statement, really saying that downside risks to growth have intensified, upside risks to inflation have intensified, and then they're not pre-committing to any particular rate path. That is the ECB using very, very cautious language ahead of a meeting where it's very hard to predict where inflation is going for the ECB. For the ECB, what they have done is they have said structurally here, we're looking at three basic scenarios. There's the good, there's the bad, and there's the ugly. And initially, last week, we heard from Christine Lagarde. She said that the situation in terms of inflation, where they think it's going, is between good and bad. From the data we've seen over the last couple of hours, John, we've got GDP data out of the Eurozone, a number of different countries, in addition to CPI data. Just look at what happened in France. France was supposed to grow in the first quarter by about 20 basis points. That came in absolutely flat. They were supposed to get inflation of 2.3%. We got 2.5%. That is the kind of stagflationary dynamic within some of these European economies that the ECB is going to be very, very cautious about. And we should say they're coming at this basically in real time. I mean, we woke up this morning on the day of the ECB rate decision with Brent at $126 a barrel. So what we're going to be watching very closely a little bit later is that press conference with Christine Lagarde. I suspect she knows what all the questions are going to be to her. I doubt that she's got all the answers.
Ollie Crook, thank you. Over in Frankfurt, Ollie's going to get in that news conference for you. That news conference with President Lagarde starts in just under 30 minutes' time. This is the central bank dilemma. You can't offer much guidance. You have to take a meeting-by-meeting approach because you've got absolutely no idea what's going to happen in the Middle East, how embedded price increases might become, or how to respond when this happens. Upside risk to inflation, downside risk to growth, and on both sides, they've intensified.
And we already are seeing it in the data. Earlier this morning, we got GDP data coming out of Europe. It came in weaker than expected. We had CPI, 3% year over year, increasing steadily, given the energy shock that you're experiencing. So what I'm curious, how much did you have some sense of what instruments they're planning to use? They said they stand by ready to adjust all instruments. Are they going to start to adjust some of their language to reflect the weakness that potentially could arise?
Let's get to this conversation with Pooja Kumra of TD Securities, joining us now from London. Pooja, welcome to the programme. The ECB and the Governing Council believes they're well positioned to navigate the uncertainty. Do you think they are?
I don't think any central bank is right now. ECB did give us a proper model with 3 scenarios on how they are supposed to react. And as we previously mentioned, we are sitting closer to the adverse scenario, which means that there are small second-round impacts. But I think at this stage, the market is so delicate that even if ECB wants to hike rates, like even a 25 basis points means that markets move 100 basis points. So I think how she communicates is going to be very tough this time.
We've seen it in recent data, Pooja. You can see that consumer expectations over the short term for inflation have risen. The ECB is acknowledging that right now. To anchor inflation at 2% over the medium term, Pooja, do you think that will require interest rate hikes?
So, as we said, that ECB is working on a model, and whatever they told us in terms of the surveys, which is the inflation surveys as well as the PMIs, they are giving us indicators that there might be second-round impacts that they cannot actually shy away from. I think for me, it's still that they would try to make
they need more data, right? We don't want to act much in terms of just one data price. I think that will be the language. But for us, it's very clear from whatever we've heard from ECB so far is that inflation is still primary. They are ready to actually keep growth secondary right now. I think they've all suffered in 2022, so they don't really want to take the risk.
Pooja, are you surprised that long-term yields keep going higher, even amid concerns about some sort of suppression to growth?
No, definitely it is something that we are really closely watching. And I think that's why if you see after the March central bank meetings, most of the central banks try to take a step back and try to actually soothe the market a bit. But if you just put the oil chart and a rates chart, they're actually moving just with 100% correlation right now. And that's the key thing. If you do not put a lid to oil prices, it's very hard to put that lid on the rates unless we get something more decisive from central banks that they are able, that they are able to say that this is just a supply shock and the prescription is not just to hike rates. It's not a demand-driven inflation right now.
Right now, we are seeing a bit of a bid into bonds, in particular German bonds. You are seeing prices go up, yields go in after rising to some of the highest levels that we've seen going back to 2011. Pooja, is this enough coming from the ECB? Just the suggestion of the dual risks coming up, even without moving. Is this enough for them to just kind of maintain that optionality for the foreseeable future?
I don't think that will be the case. I think as far as we know, Lagarde is concerned, she will still try to say that they are still waiting for data points. But for me, the key risk is that, yes, we have lots of data points coming into the June meeting, which is one more consumer survey, one more PMI report, and one more CPI report. And also the fact that this is the time that hawks have become much more vocal, right? So even if today's conference is kept a bit more neutral and data dependent, we'll all be conscious as to how different groups of the central bank come in next week, just given the fact that we know that this crisis is not ending anytime soon.
Pooja, what can we learn from the ECB and how they dealt with the other energy shock with Russia's invasion of Ukraine?
I think at that stage, what we learned from that time was that they managed to anchor inflation primarily because the demand shock wasn't a case in Europe. So, they just had to tackle the supply part of it. I think the situation is exactly the same when it comes to Europe right now. We did have a big German fiscal spending last year, but we can see the demand has still not moved at all. So I think in Europe, the lower wage growth, the lower growth, the lower productivity potential as compared to US and UK does suggest that that spiral effect is not going to be there in Europe. But we also know ECB is laser focused on inflation right now. So they will be possibly the first to act, but they might have to reverse it just because the real economy is not exactly the same as compared to 2022.
Pooja, good to hear from you. Thanks for the reaction to the ECB decision. Pooja Kumra there of TD Securities. Yields are lower today across the curve worldwide, not just the US, but Europe as well. Crude is helping to encourage that move. Crude is pulling back from wartime highs that we hit a little bit earlier on this morning. But also I'd say this as well, it's always relative to expectations. It's difficult to out-hawk. Pretty hawkish pricing for the ECB and the Bank of England coming into these two decisions. Yeah, buy the rumor, sell the news. At what point are we talking about that type of reaction? That said, I do think it's notable that this is enough to calm market expectations of longer-term inflation, at least in the margins. And you could say we're getting no signal whatsoever because it's all driven by oil prices. So what are we even talking about here with central banks? Ultimately, they've lost control. And they're saying, as we've lost control over this situation, we're going to step back and we're in a position to do so. And right now, you're not seeing inflation expectations run away over the long term. For now, at what point does that change, given the fact that in some places the strength in the economy is enough to keep some of the inflationary pressure? I think we've said it 1,000 different ways already this morning. First and foremost, they want to anchor inflation expectations. That's their job. But you can sense the reluctance to actually hike interest rates at these institutions. As for the other headlines, I've got to get to this from Meta. Meta's spending a lot of money. That's not news. You know that. This is the news. 6-part bond offering from Meta. They're kicking that debt sale off this morning. And we know what they're looking to raise. They're looking to raise as much as $25 billion from that bond sale. They are not alone.
And this is why people have said you can throw anything at this market and it will just take it. I'm looking right now at investment-grade bond spreads, the extra yield over benchmark rates that people demand to own investment-grade debt. It is 80 basis points. It is less than 1%. It has gone down through this, even with a bonanza of debt sales, not only from corporates, but also from governments, and even amid all the concerns with respect to oil prices. So you look at this and you start wondering, is there going to start being pushback by investors to CapEx plans that are filling the holes that are made by inflation and potentially concerns about what the business model really looks like going forward?
Which market, which investors? Because right now, in the bond market, to your point, we've seen great demand for these debt offerings whenever they come from these big companies. For the equity market, not impressed this morning. Meta down by close to 9%, the smallest bounce off the low this morning.
Yeah, and not necessarily impressed with the fact that they're increasing CapEx without a real plan of exactly how they're going to use it. At this point, does this continue to be a repeat of what we saw late last year, although just for Meta, while the likes of Alphabet continue to do really well?
And geopolitics really hitting Meta on two fronts. The components you talked about earlier, but also the fact that some of their subscriber growth and advertisement has been hit what's going on when it comes to Russia and Iran they talked about yesterday. So, tough spot.
Economic data just around the corner. That data drops in about 5 minutes' time. The news conference with ECB President Christine Lagarde coming up in about 20 minutes' time. Then 1 hour from now, got to repeat this programming note, NEC Director Kevin Hassett joining us on an extended edition of Bloomberg Surveillance to accommodate that conversation following quite the announcement from Chairman Powell yesterday in the news conference. The chairman is heading to the exit. As the chairman, he's sticking around as a governor. Controversial move from the Fed chair. We'll get the reaction from the White House a little bit later this morning. Up next, the data and reaction with Jonathan Pingle of UBS. Economic data just seconds away. The price action shaping up as follows. 60 minutes away from the open and bound. The cash open just around the corner. Equity futures near session highs up by 0.6% on the S&P. On the Nasdaq 100 up by 0.8. Crude pulling back by 3% on Brent to 114, unlocking this move in the bond market. Yields down by 5 basis points on twos, 389. All of that just on the margin, helping to support risk appetite when things were getting a little bit shaky earlier on this morning. Economic data just crossing the Bloomberg. Let's break it down and cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. It's dropping in fits and starts, but we've got a lot of numbers to talk about. Let's start with the inflation outlook, the inflation side of the Fed's mandate, and that is the PCE price index for the month of March, up 0.7%. That is almost double the 0.4 the months before, and it is what was expected. The core on a month-over-month basis up 0.3 as expected, down just a little bit. But that puts our numbers exactly where Jay Powell said they would be. Index for prices year over year, 3.5%, and for the core, 3.2%, significantly far away from the Fed's 2% target. Now, as part of that report, we also get income and spending. Income's up 0.6%. I'll get the breakdown where that comes from for you a little bit later. Personal spending up 0.9 as expected. Consumers hanging in there a little bit. All of this feeds into the GDP report. GDP for the first quarter. This is the first report for the first quarter, up 2%. It was a 0.5% gain in the fourth quarter of last year. The 2% comes in lower than the 2.3% that had been expected. Personal consumption stronger, though, 1.6%, 1.4% was expected. The employment cost index is a little stronger, up 0.9% compared to 0.7 the prior quarter and 0.8 for the expectation. We'll get a breakdown on that for you in just a second, whether that's wages or the sort of benefits and insurance. And then finally, we'll go to the employment side of the Fed's mandate. 189,000 is the jobless claims number. It's sort of ridiculously low here. 215,000 was the number for the prior week. On a continuing basis, 1,785,000, down from 1,808,000. So a lot of numbers out there to digest. I'll look at some of the details of those, John, but we'll see what the markets think all of this together.
You take some time, Mike. I'll come back to you in just a moment. Equity futures, just your update, was near session highs, just off those levels, still positive by 0.5%. Yields give up some of the move this morning, down by 5 to 6 basis points at the front end of the curve, now down by 4 to 5. Let's break this up and start with the labour market data. The argument that we've heard repeatedly about why you won't see price pressure take off in this economy is that the labour market simply isn't strong enough. Now, that's the consensus view on Wall Street. Does the data stand up to that argument pretty well this morning or not?
The ECI came in hotter than expected. Initial jobless claims, and maybe I'm looking at something wrong, came in at the lowest level going back to the late 60s. I'm going to go double check that, but this is how low the levels are that we're seeing in terms of initial jobless claims. So if you're looking at the fact that the labor market data on the margins is coming in hotter than expected, and the fact that jobless claims came in at, to quote Michael McKee, a ridiculously low rate, this does suggest the heat that Neil Richardson was talking about. She said this is a market that is actually re-accelerating on the heels of some of this CapEx.
Let's get to Jonathan Pingle of UBS. He's been tracking the numbers as well. Jonathan, good morning.
Morning. Thanks for having me.
I got an email earlier on this week, and it said, love the show, but I was like, oh, here we go. And then it said, Thursday mornings, 8:30, every single time I cringe, because you all get excited about how low jobless claims are. And then there were all these questions and marks about how valid that data actually was. Is that the real deal, 189? Does that tell you much about this labour market and what's actually happening in this economy?
Yeah, I mean, I'm not quite sure how to what the witty retort to that is.
Has something changed
they're
with
low, and I think
employment
it's
insurance that makes it difficult to actually get a read on whether the economy and the labour market is weak or not, based on weekly jobless claims?
Well, I mean, it is only sort of one side of the. It really is only one side of the equation. I mean, you know, if you think about if you smooth through some of the week-to-week volatility, initial claims are certainly low. They're running about 205. I'm gonna guess that's the 4-week moving average with this number, and maybe it's closer to 200. But that's basically been bouncing around there since January. And if you think about it, we have had basically pretty stable, low level of layoffs. This isn't that much different than 2018, 2019 layoffs. But the question for the Fed is, hiring has come way down. I think, though, if we think about continuing claims coming in, that's a sign that, maybe hiring is kind of fine, and we're still treading water there as well. But, I think looking at the swath of this morning's data and thinking about yesterday, thinking about the overnight news about CapEx, I mean, that really is what the really big driver, overarching theme is right now. Because, as much as, real consumption came in at 1.6, tiny bit ahead, that has slowed. I mean, if you look at the last few quarters, real spending has definitely cooled. Real disposable income has come in, even with this ECI reading, we're still going to have, year-over-year gains in nominal wage growth around 3.5%. So, overall, that's still a story of we have seen the slowdown in the labor market. It's spilled over into slower income growth. But, man, the CapEx is off the charts
incredible, isn't it? It's incredible, the stimulus program coming from these 4 tech companies overnight, as we've referred to it as.
Yeah, although we keep saying, okay, it's these companies and these companies alone. This paints a very different picture. The fact that personal income came in at 0.6% versus 0.3% was revised up for the prior month. The same thing goes for personal spending, 0.9%. It was revised up from 0.5% the previous month. Every single indicator here, with the one exception, a very interesting exception of GDP, coming in better than expected at a time when it's not just the hyperscalers and their CapEx. So what's behind it, and how resilient can that be in the face of a consumer shock?
Jonathan, the bar for hiking got a little bit lower. Certainly not the consensus view that that's the base case for the year ahead, but the bar for hiking got a little bit lower. Do you think we're still underappreciating the potential for broad-based price pressure in this economy and the ability of this labour market to support it?
Well, I think the economists like me might be, but I think the market looks like it's pretty ready to price in hikes. I mean, when we saw the initial reaction to the oil price shock back in early March, I mean, market was pretty quick to price in like near-term hikes, which would be a remarkably fast pivot for the Fed. And yesterday, if you step back and you think about the information we got, I mean, 9 FOMC participants voted for an easing bias. One of the 9 voted for actually easing, even though they knew core inflation was 3.2% and there's upside risk from energy, right?
Yep.
So I don't think, so that was the committee. The market, though, still looked at that and said, okay, we've got to price in more hikes. So now we've got a really flat forward curve for Fed funds futures, then it turns to hikes in early 27. So the market's kind of getting there already. I still have cuts in the forecast. So it's really like the economists like me that are actually still like saying, well, we think inflation's going to be fine in the end, blah, 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 blah.
Mike McKee has got more data for us. Mike, what do you see?
Well, we're looking at the GDP numbers, which, of course, came in as a surprise, up just 2% when the forecast was for 2.3. Right now, it looks like what it is inventories and net exports. Inventories fell by $7.5 billion instead of adding. They are down, and trade was down significantly as well, thanks to a big drop in a big increase in imports, which subtracts. We did get a rebound in government spending from the back of the government shutdown in the fourth quarter. Non-defense government spending was up 20.3%. But the numbers that really matter, personal consumption 1.6%, the lowest since the first quarter of last year. But business non-residential fixed investment up 10.4%. Of that, equipment was 17.2% higher and intellectual property 13% higher. So a really significant increase in business spending offsets some of the consumer weakness. Looking at the employment cost index, it is both wages and salaries and benefits. Wages and salaries up 0.8%, which is higher than the 0.7 that we saw in the fourth quarter. Benefits up 1.2%, and that's the strongest in some time. Last quarter was a 0.8%. Still looking at the rest of the numbers, but I can confirm that what Lisa told you is correct. It was September of 1969.
Wowza.
That we last saw jobless claims this low. Your explanation is as good as mine. I guess companies just sitting on their hands at the moment.
Mike McKee, thank you, sir. And of course, back then, very different population size as well. So that's an incredibly impressive number at 189. In some parts of this economy, I stress some parts, we've got boom conditions off the back of some of that CapEx.
We have had boom conditions, I would argue, and that's what's saving this economy from experiencing anything other than strength. The interesting aspect is this just a low hire, low fire situation, or are we breaking out right now? And that, I think, is what Neela Richardson was signaling. And the fact that wage growth is as strong as it is, are we going to hear people, economists like Jonathan Pingle, discuss about productivity and how you're starting to see that work through in this beneficial nirvana rather than, computers taking over the world?
John, you get the final word, slow and stable, low hire, low fire. Are things breaking out to the upside?
Well, I think definitely the CapEx looks very strong. And I think, Mike was just talking about in terms of the GDP report. I mean, we're watching equipment spending rise almost 20% at an annualized rate. And yet consumption, 1.6. I mean, that compares to we were running over 3% annualized, through 23 and 24. So, we really have reoriented this economy towards very strong CapEx, which just by composition is going to boost productivity growth.
Super impressive. Jonathan Pingle there of UBS. They're the conditions that are unique to America right now that the Europeans just do not have going into this news conference with Christine Lagarde in 5 minutes' time.
If you take a look at the U.S. Economic Surprise Index versus the European Economic Surprise Index, they've diverged to one of the widest points that you've seen going back many years. And it is shocking. That is what Christine Lagarde has to address. And the reason why this market feels a little bit more imperiled when you go over to Europe.
The data in Europe, not so good. Upside risk to inflation, downside risk to growth, and those risks, according to the ECB, have intensified. That news conference just around the corner. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Recapping the data we just got then, PCE inflation data coming in line with expectations at plus 0.7%, nearly double the rate of the previous month. Core PCE coming in at 0.3%, also in line with estimates. First quarter GDP up 2%. That was just under estimates, but a big rise from the previous quarter. And initial jobless claims coming in historically low at 189,000. That's a good sign, obviously, for the labour market. A pair of central bank rate decisions this morning, both the Bank of England and the ECB holding rates steady. ECB officials signalling they need more time to weigh the economic impact of the Iran war. The Bank of England signalling it could raise rates if energy disruptions continue. Another check on tech earnings. Shares of Qualcomm higher in pre-market trading. The chipmaker reporting growth in the data center market and predicting that the China phone industry would bounce back. Qualcomm also sharing that a top hyperscaler is on track to start using Qualcomm components later this year. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, the ECB President Christine Lagarde, her news conference following the latest decision from the ECB. And then later, we'll catch up with the National Economic Council Director, Kevin Hassett, from New York City. You're watching Bloomberg TV.
The administration is encouraging more CapEx, and the good news is that the market is rewarding more CapEx, more investment, less consumption to get higher productivity. I think it's really important that companies continue to allocate capital in a way that leads to higher productivity.
CapEx boom. You see it in the data. That was Mike Wilson of Morgan Stanley. You see it in the price action too. Near session highs on the S&P 500, up by 0.5%, higher by 0.6% on the NASDAQ. Let's get you some single names. Some morning movers. The opening bell about 44 minutes away. Yahira has more. Hey, Yahira.
Hi, John. We start with Ford. Those shares are falling up 4.25% in the pre-market as the car maker says that rising commodity costs tied to the war are expected to hit profits by about $2 billion. That overshadowing a beat and a raise at the car maker. But even that has analysts skeptical who say that was helped by a one-time tariff benefit. Turning to Caterpillar, those shares are up in the pre-market, up 6.5% after a massive beat as this legacy industrial name known for bulldozers becomes part of the AI revolution. It's seeing massive demand for its turbines and its generators, all used to power AI data centers. And we end on Royal Caribbean, those shares also rising nearly 7% in the pre-market, even as guidance fell short due to rising fuel costs, but investors clinging on to this. Royal saying that after a dip in March and April, bookings have recovered and are running ahead of last year. John.
Yahira, thank you. Thanks for the update. Ahead of the cash open, plenty of stock movers out there, some big single name stories. In just a moment, the ECB conference, the news conference kicking off with Christine Lagarde, the ECB president, in just a second. We'll head over to that in a minute. The outlook for policy is changing even at the Federal Reserve. BNP Paribas just moments ago, we expect the Fed to stay on hold into 27. Saw the same headline coming from Mike Gapin of Morgan Stanley overnight.
You said something so interesting. We started the year expecting the ECB would have to hike rates because of the oil shock and that the U.S. would remain on hold. It's flipping. This is the your question. Is the rhetoric completely different from the Central Bank of Europe?
We need to talk about two things here. On the one side, we need to talk about rate pricing. The pricing in the market already, which of course is always paramount. This market was priced pretty aggressively for rate hikes through this year for both the ECB and the Bank of England. Difficult to really meet those expectations at today's meeting. But in isolation, you've got central banks that are far more open to raising interest rates now, both across the Federal Reserve, the Bank of England, and the European Central Bank compared to where they were only several months ago. We're also getting some signs of intervention as well, which we need to talk about over at the Bank of Japan. This headline crossing just moments ago that Japan, according to Nikkei, conducted a yen buying operation. You will have seen the headlines from the finance ministry overnight saying that we were close, threatening to make such a move. A final warning, if you will, to the FX market, pretty much in their own words. Confirmation from Nikkei just moments ago that Japan did conduct a yen buying operation.
This came after the yen reached its weakest point versus the dollar going back to late last year, and comes along mounting pressure of how they're going to support the economy given the dual pressures of both higher oil prices and inflation, but also potentially weaker growth.
If you're just tuning in, welcome to the programme. The opening bell is just seconds away. This is a special extended edition of Bloomberg Surveillance going into the cash open. Haven't done this for a while. This is nice. Equity futures firmer on the S&P 500 by 0.5%. On the NASDAQ, higher by 0.7%. A little bounce on the Russell, up by 1/10%. Encouraged by this move in crude. Brent and WTI backing away from wartime highs. 113 on Brent, 104 on WTI. And check out what this does to the bond market. Just helps to unlock this move in fixed income. Yields lower across the curve. 2's down by 6 basis points. 10's Bramo down by 5.
This comes after we saw the highest levels, and particularly at the 30-year yield that we've seen in a long time at the 5% level. At what point does that act as a constraint? And this has been the conundrum. On one hand, you could say oil prices act as a constraint. On the other hand, we see the CapEx plans and we see better than expected U.S. economic data. And it points to the resilience in the underlying economy that can allow some of this inflation to persist. At what point does the Fed respond? We've seen the Fed get more hawkish as the ECB potentially backs away from some of the rate hikes priced in.
Let's talk about this economy. U.S. economic growth accelerating at the start of the year, fueled by solid business and consumer demand, insulating this economy from heightened geopolitical risk as the Fed remains very much on the sidelines. Joining us now to discuss is the National Economic Council Director, Kevin Hassett. Kevin, welcome back to the programme, sir. Always good to catch up. We'll talk about this economy in just a moment. I think we need to follow on from the Federal Reserve and the news conference with Chairman Powell just yesterday. Stepping aside as the Fed chair, but staying on as a governor. Kevin, was anyone in the administration given a heads up ahead of time before you heard that announcement?
You know, communications with the Federal Reserve and the administration are still open when there are policy concerns, but I can't really discuss that. I could say that I'm disappointed in what Jay said, but I'm going to sort of stay out of it as we await just a couple weeks Kevin Warsh's confirmation. I think when Kevin gets in there, it's going to really be a sea change at the Fed that we're all looking forward to.
Kevin, in the meantime, the president has articulated his disappointment like you just have. Previously, the president suggested that if the chairman stayed on beyond his time, not sure what he meant specifically by beyond his time, that he would fire him. Is the president intervening certain options to intervene?
You know, I think that in the end, our hope is that Chairman Powell understands that the Justice Department has stood down. They've just asked the Inspector General at the Fed to look into this, which is something the Inspector General is probably doing anyway. And so that I think that it's time to de-escalate and move on.
Kevin, do you think the president has sufficiently de-escalated to allow him to move on?
Well, he doesn't think so. And I think that in the end, he'll study the matter, and we hope he comes around.
The Treasury Secretary says it's an insult to the other Republican nominees on the board, the likes of Governor Waller, Mickey Bowman, people that you and I know fairly well. Do you believe it's also an insult, and does it complicate the way this particular institution will operate in the months and meetings to come?
Again, I don't want to start getting too much into having the White House argue with the Fed right now while we're waiting Kevin Warsh's confirmation, which looks like it's a lock to me. The bottom line is that Kevin Warsh is going to go in there. He's going to be new leadership. He's going to be fresh leadership. And we fully expect that that's going to help everybody see how important the independence of the Fed is. Now, as a logical matter, if you just sort of say, hey, we'd like the IG to look into something, the IG is the Federal Reserve's Inspector General. And so it's completely respectful of the independence of the Fed. We do respect the independence of the Fed. And I think that the best way to show that it's not a partisan organization is to move on.
There has been a pretty aggressive push to reduce interest rates. At the same time, this Federal Reserve is shifting towards articulating a more symmetrical reaction function. Not there yet, but getting closer to it, Kevin. Supporting that is the economic data from earlier on this morning. Do you think there is space just to wait, to see, to work out how things turn out before thinking about reducing interest rates?
Right. Well, first of all, let's talk about the economic data for a second, because it was just kind of a whole bunch of blockbuster numbers. The 2% number, actually, you know, for me, being capital spending guy, I used to be the capital spending guy at the Fed when I was a young economist, that the thing that was amazing, as you know, is, and you highlighted, the capital spending boom. And one of the things that sort of dragged it down from a really high number was that the quality of the imports has skyrocketed. And so almost half of the imports were capital goods, which were coming in to build factories in the U.S. Typically in the past, you know, our imports are things like consumer goods that are perishable. And so the bottom line is that it's really strong data. We got initial claims, the lowest they've been since the 1960s. We got government employment, the lowest it's been since the Second World War. We've got all these positive movements in terms of fiscal responsibility and economic growth moving forward. And so then, but we do have this temporary disruption with energy markets, which is very serious. As you mentioned, the energy prices are high, gasoline prices are high. But, you know, my read of the academic literature on what you do when you have an oil shock like this is not that you raise rates into it, especially given how I think we're highly confident that this is going to be a temporary disruption. Futures markets agree with that as well. And so I think it would be a policy error for, you know, the ECB or the Fed to hike rates into a temporary spike in energy prices. And their own economic studies sort of suggest this is true, because if you look at it, what they want to do is make sure that future inflation goes back towards the target. The best forecast of future inflation is not top-line inflation, but core inflation. And core inflation in the last CPI number was fine. The PCs kind of crept up a little bit, but it doesn't tell the story of the top line. And the top line is the kind of thing that I think someone could overreact to.
It might not be appropriate, Kevin, to have a rate hike at this point, but do you agree with your colleague, Treasury Secretary Scott Bessent, who came out and said it might be appropriate to stay on hold for a while as this does progress and works itself out?
Again, I am highly confident that the productivity boom is going to keep core prices under control, and that my old friend Alan Greenspan in the 90s saw that because of the computer revolution that we could have high growth and there wasn't a Phillips curve kind of thing that you needed to respond to, as he let us have 4 or 5 of the best economic years that we've seen in my lifetime. And I think that we have that opportunity again, and it would be a shame if we squandered it.
So you think that it is appropriate to currently cut rates, despite the increasing concern by some of the Fed members that we are entering a potentially inflationary moment? Do you think it's inappropriate to go to something more of a symmetric type of approach?
Well, they've been sort of saying we're leaning towards cutting, and then there was some dispute about what's going to happen at the next meeting. But I think that getting interest rates down could really supercharge the economy from where we are, but not be super inflationary. So you saw that the weak spot in the GDP report was residential investment, which was down 8%. Residential investment is kind of the most interest-sensitive thing there is, and I think that Fed policy has a chance of moving the yield curve in a way that could really help home buyers. And one of the things that I remember from the 90s is that when we want to have sort of low inflation, high growth, then one of the things that happens is you get a lot of construction, residential construction. And when you have residential construction, it has a big positive effect on GDP because you have like an empty house that has to get filled with a washer, dryer, and a TV, and carpet, and furniture, and everything else. And that's much different than if you have like an old house where you're moving from one old house to another. And so new construction is really the thing that could lift this to 4 or 5% growth, and it's being held back by high interest rates.
What's the pathway to get there, given the fact that the longer-term yield curve is seeing some of the highest rates that it has this cycle, 5% in the 30-year yesterday for the first time in a while. And frankly, a lot of people in the market think that if the interest rate were cut at the front end, that would only exacerbate the creep higher in yields at the long end. How do you see that?
Yeah, I mean, there are times when that's true, but not a time when we're in the middle of a huge positive supply shock. And so I think a little bit of movement, and Kevin Warsh, hopefully soon to be Chairman Warsh, has described how one can do that and maybe play with the balance sheet a little bit at the same time and move things in a direction that helps America's homeowners. And I think that if we could get that last little bit of the economy going on all cylinders, then we'd really be back very close to talking about the golden days.
Kevin, we have triple-digit crude this morning, WTI, much higher. And actually what you're seeing across America, especially in a place like California, they've actually breached $6 a gallon when it comes to gasoline. I know the White House has some measures. They've extended the Jones Act waiver. But what else are you thinking about?
Well, we've already done a whole bunch of things, including, basically opening up the drilling that was offshore drilling in California that was shut down by the state, and that's actually, alive and pumping out barrels. The bottom line is that we're very convinced that this is, a suicidal Iranian regime that was set on really big disruptive things in the region that would be perhaps permanently harmful. And that when we had, them signal in their negotiations that they were just about ready to have 11 nuclear bombs, then the president decided to take action to defend the entire earth, for goodness sake. And so right now, the thing that I look at as in terms of the economic effects of the war is how difficult it is for Iranians right now. As if the government doesn't care about them at all. And so they're having a hyperinflation, they're running out of food, they don't have any distilled product to drive around in their cars, they're shutting down businesses, even the Persian rug dealers are shutting down. It's time for that government to just see that they shouldn't aspire to have a nuclear weapon, and if they just give that up, then we can go back to having normal relations, one could hope.
Right, but what could this government do to shield Americans from higher gasoline prices? Are things like an export ban on the table?
No, what we've done is we've, as you know, we've done the Jones Act. We've opened up drilling in California. We've, pursued changing the ethanol standards so that the corn ethanol can be used more in the summer. We've taken every single step that we can, and we understand that it would have been a lot worse if we hadn't done that. But the fact is that our expectation is that things are going to get better very, very quickly if we could just get the Iranians to finish the negotiations and realize that it's in the interest of their own people to stop things that could turn into serious hunger events and so on.
Kevin, unfortunately, and you and I are probably in agreement here, unfortunately they've got a track record of doing a lot of things that aren't in the interest of their own people. In the meantime, there seems to be a preference to maintain the blockade and put the squeeze on them. How close are we to them breaching storage capacity, so to speak? What's our understanding of that? Do we have a decent gauge of where things are at inside the country?
It's a well-to-well thing. But the basic idea is that if you shut down a well, then the pressure can build, and then the oil can kind of squirt everywhere, and then when you open the well up again, you get a lot less oil out of the well. That's the sort of theory of what could happen. And it's certainly possible, because they're running out of storage, that they're going to have to shut in wells. The one thing I can say is that their production went from 5 million barrels a day to 1 million barrels a day because of President Trump's policies in the previous term, when he really put in tough sanctions on Iran to try to stop the nuclear program. And after Joe Biden came in, he just stopped the sanctions, and the energy production went back up to 5 million barrels a day over a couple of years. And so the Iranians, it took them a couple of years to get things fixed, probably with new wells and so on, because it can harm wells. But we have an experience of them being shut almost down to nothing and then getting back up.
Kevin, are partners stepping up to help? We're just hearing from the president here out on social media, so I'm sure this is the first time you're hearing of it. I'll read it for you. The Chancellor of Germany should spend more time on ending the war with Russia and Ukraine and fixing his broken country, especially immigration and energy, and less time on interfering with those that are getting rid of the Iranian nuclear threat, thereby making the world, including Germany, a safer place. I believe the German Chancellor earlier this week suggested that the president was being humiliated by the Iranians. Just what is the relationship like, Kevin, with our European partners at the moment?
I think that the European partners are feeling stress because their very unwise energy policies have exposed them much more to energy shocks from the Middle East. And it looks like the German Chancellor is losing his cool a little bit, and I would suggest that he take a deep breath and recognize that the best way for Europe to get its economy back on track is to, help us resolve this problem, and then also examine their own policies, which are so anti-free market that their economies are, happy when they get 1% growth. I think Germany's a great country. I lived there for a time, and I think there's a heck of a lot of potential for that country, but they sure aren't achieving it right now, and it's not just because of oil.
Kevin Hassett, we appreciate your time, sir. Thanks for making time for us this morning. Thank you very much, as always. The NEC Director, Kevin Hassett, there on the economy and the situation with the Federal Reserve. Just a note on the Federal Reserve. Resisting the temptation to turn up the heat and have a back and forth with the chairman of the Federal Reserve, Jay Powell. They clearly want to open the door for him to head to the exit.
They also want confirmation, a clean confirmation of Kevin Warsh to get him in before anything else. So right now, the White House is putting a clamp down on any kind of heating tit for tat between them and Jerome Powell, hoping that it will resolve itself in the intermediary. Really interesting, though. That is the time frame. They want the confirmation first, and then maybe the gloves come off.
Interesting note to finish the conversation on the difference between Europe and the United States right now. Of course, they feel the squeeze over in Europe. Of course, they're stressed. They have GDP running close to zero, and it could be zero if this continues. You can see the stress and the tension in the ECB news conference over the last 60 minutes or so. There is a CapEx boom driving this equity market and insulating this economy stateside that others just don't have. Europe just doesn't have?
Well, if you think about Europe versus the U.S., and this is a reason why you're seeing better economic performance and surprises in the U.S. than Europe, not only does it have the CapEx boom of technology, it's also an oil producer and actually almost a net oil exporter for the first time. Well, Europe has neither, right? It doesn't have the tech boom and it doesn't have the energy reserves in its own place. So how do you then get yourself above this? This is what we heard Christine Lagarde dealing with, and this is the reason why you're seeing the economic data diverge.
Europe is struggling, which is why the president also wants Europe to step up to join them when it comes to trying to reopen the Strait of Hormuz. The Wall Street Journal overnight was talking about how a diplomatic cable was sent from the State Department to embassies telling their officials to press these foreign governments to help them in a maritime freedom construct to try to reopen up the Strait of Hormuz. But to Lisa's point, we are a net energy exporter. We will feel some of it, but we're much more insulated. Europe is not.
Fun morning. I'm not suggesting we do this every morning, but fun morning, right?
Oh, I think it was great. I mean, honestly, it's been such an active, interesting week. I could just stay here the rest of the day.
One more day to go, Bramo. One more day. Keep it together, OK?
Oh, I am. I'm doing great.
Coming up tomorrow, Ajay Rajajaksha of Barclays, Tom Forday of Maxim Group, Victoria Fernandez of Crossmark, and the NASA administrator, Jared Isaacman. Looking forward to that conversation from New York City. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.